Good morning, everybody. We have a lot to talk about, a lot to get into, a lot of headlines, PPI data, bunch of earnings, but Jerome Powell's live, so let's get to him immediately. Here we go. We'll be talking in a second, but here is J Powell going live now.
2008. After liftoff in December 2015, we were able to raise the policy rate only very gradually over a period of 3 years to a peak of just 2.4%. 7 months regularly ran below its target. The sense at that time was that when the economy next experienced even a mild downturn, we would be right back at the lower bound, probably for another extended period. The post-financial crisis decade had demonstrated the pain that could bring. Inflation would likely decline in a weak economy, raising real interest rates as nominal rates are pinned at zero. Higher real rates would further weigh on job growth and reinforce downward pressure on inflation and inflation expectations. Reflecting these concerns, we adopted a policy to make up for persistent shortfalls from the inflation target, an approach that was common in the extensive literature on the risks associated with the lower bound. Given the downside risks to employment and inflation from proximity to the lower bound, and the need to anchor longer-term inflation expectations at 2%, we said that following periods in which inflation has been running persistently below 2%, we would likely aim to achieve inflation moderately above 2% for some time. We also concluded that policy decisions would be informed by assessments of shortfalls rather than deviations from maximum employment. The change to shortfalls was not a commitment to permanently forswear preemption or to ignore labor market tightness. Rather, it signaled that apparent labor market tightness would not, in isolation, be enough to trigger a policy response, unless the committee believed that, if left unchecked, it would lead to unwelcome inflationary pressure. This change reflected our experience with long expansions that featured historically low unemployment amid low and stable inflation, suggesting that a policy approach that carefully probed for the maximum level of employment could bring about the benefits of a strong labor market without risking price stability. In the years just prior to the pandemic, for example, unemployment was at multi-decade lows while inflation ran below 2%. By December 2019, estimates of the longer-run unemployment rate had fallen sharply. The use of shortfalls acknowledged that a combination of low inflation and low unemployment does not necessarily pose an adverse trade-off for monetary policy. The economic conditions that brought us close to the lower bound and drove the changes in our consensus statement were thought to be rooted in slow-moving global factors that were likely to persist for an extended period, at least until our next 5-year review. And that might well have been the case had the pandemic not intervened. The idea of an intentional moderate overshoot proved irrelevant to our policy discussions and has remained so through today. There was nothing intentional or moderate about the global inflation that arrived a few months after we announced our changes to the consensus statement, and I acknowledged as much publicly in December 2021. We fell back on the rest of the framework, which called for traditional inflation targeting. Through the end of 2021, FOMC participants continued to forecast that inflation was likely to subside fairly quickly in 2022, with only a moderate increase in our policy rate. That projection was consistent with other central banks with different frameworks and the vast majority of forecasters. When the evidence showed otherwise, we hiked 525 basis points over a period of 16 months. The most recent data suggests that 12-month PCE inflation was 2.2% in April, far below its 7.2% peak in 2022. And in a welcome and historically unusual result, as this room knows, this disinflation has come without the sharp increase in unemployment that has often accompanied a campaign of rate hikes to reduce inflation. The economic environment has changed significantly since 2020, and our review will reflect our assessment of those changes. Longer-term interest rates are a good deal higher now, driven largely by real rates, given the stability of longer-term inflation expectations. Many estimates of the longer-run level of the policy rate have risen, including those in the Summary of Economic Projections. Higher real rates may also reflect the possibility that inflation could be more volatile going forward than during the inter-crisis period of the 2010s. We may be entering a period of more frequent and potentially more persistent supply shocks, a difficult challenge for the economy and for central banks. While our policy rate is currently well above the lower bound, in recent decades, we have cut the rate by about 500 basis points when the economy is in recession. Although getting stuck at the lower bound is no longer the base case, it is only prudent that the framework continue to address that risk. While the framework must evolve, some elements of it are timeless. Policymakers emerged from the Great Inflation with a clear understanding that it was essential to anchor inflation expectations at an appropriately low level. During the Great Moderation, well-anchored inflation expectations allowed us to provide policy support to employment without risking destabilizing inflation. Since the Great Inflation, the U.S. economy has had 3 of its 4 longest expansions on record. Anchored expectations played a key role in facilitating these expansions. More recently, without that anchor, it would not have been possible to achieve a roughly 5 percentage point disinflation without a spike in unemployment. Keeping longer-run inflation expectations anchored was a driving force behind establishing the 2% target in the 2012 framework. Maintaining that anchor was a major consideration behind the changes in 2020. Anchored expectations are critical to everything we do, and we remain fully committed to the 2% target today. In the current review, the committee is engaged in discussions about what we have learned from the experience of the past 5 years. We plan to complete consideration of specific changes to the consensus statement in coming months. We're paying particular attention to the 2020 changes as we consider discrete but important updates reflecting what we have learned about the economy and the way those changes were interpreted by the public. In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting. We will ensure that our new consensus statement is robust to a wide range of economic environments and developments. In addition to revising the consensus statement, we will also consider potential enhancements to our formal policy communications, particularly regarding the role of forecasts and uncertainty. As we have been reviewing assessments of the 2020 framework and of policy decisions in recent years, a common observation is the need for clear communications as complex events unfold. While academics and market participants generally have viewed the FOMC communications as effective, there is always room for improvement. Indeed, clear communication is an issue even in relatively placid times. A critical question is how to foster a broader understanding of the uncertainty that the economy generally faces. In periods with larger, more frequent, or more disparate shocks, effective communication requires that we convey the uncertainty that surrounds our understanding of the economy and the outlook. We will examine ways to improve along that dimension as we move forward. So let me end by saying thank you again for being here. We've been looking forward to this. All of us have been looking forward to being with you today and having these conversations that will occur over the next 2 days. These discussions will help broaden and deepen our thinking about these issues, and they're critical to the success of these reviews. Thank you very much.
Right, thank you very much. We are going to just roll right into our first paper session today. On the agenda today will be sessions that address the 2 sides.
I guess that's it. I thought they were going to do a Q&A, but no, I guess that's pretty much it. I don't really know what Jay Powell said, to be honest. Yeah, now they're getting into some sessions. This is at the Economic Club of DC or Chicago, one of these. Okay, so, yeah, Powell said nothing. I mean, does anyone know what he said? I don't. All he said was, I think the one quote we have from him is that higher inflation is still a risk. And that he says it's appropriate to reconsider the average inflation target. And he does not comment on the near-term. Yeah, so the summary is he has not commented on the near-term economic outlook, and he has not given any guidance on what the Fed is going to be doing with rates. Which, I mean, probably was expected that he wasn't going to say anything that specific, but he said really nothing that specific that I think the market could even hold on to. S&P 500 right here in the pre-markets is down about 0.5%. The reason we're down, I think, is honestly just because we're giving back some of the gains that we had over the past couple of days. We'll talk about a lot of the macro data we got this morning. Good morning, everyone. Thank you for being here. But in terms of what Powell said, I do not think it had anything to do with any of the stock price reactions that we're seeing right now. So as Broccoli Bob asks the question, what was the point of this? Honestly, I don't know. I mean, I guess the point of this was for him to introduce the beginning of this conference. So if you're at the conference, I guess it's important. But for market participants, there's not any new data we're really getting from what Powell's saying. Having said that, let's get into the macro data that we got today. Folks, we've got some pretty juicy macro data. And all of this macro data, once again, is suggesting that it's time to cut rates. Headline PPI, Producer Price Index, comes in at 2.4 versus 2.5% expected. Again, another beat on inflation. Core CPI or core PPI comes in at 0.4% negative versus 0.3% expected. This is the biggest drop since April of 2020. I think it's time to cut rates. Now, the Fed probabilities for June on a rate cut are still 8.2%. So it's not like anything changed from the 8 minutes that Powell just had in terms of him talking on that stage. However, what has changed overnight, which is very, very aggressive, and we'll talk about what Trump said about this, because you can tell Trump is starting to get a little worried about how this is playing out. The U.S. 10-year is now above 4.534%. 4.534%. The bond market is selling off right now, which is causing yields to go higher in the pre-market, primarily because even though this PPI data was pretty incredible, right? Like you got core PPI coming in at negative 0.3 versus positive expected. You have headline PPI coming in at 2.4 versus 2.5. The issue is, if none of it's going to get J Powell to cut in any meaningful capacity, then, I mean, you know, why would people buy bonds? I mean, the issue right here is not only are we risk on in a stock market, but we have a Fed that is not giving any signal, and he didn't give any signal today, that he was getting ready to cut. And I think that's kind of the broader problem that we're seeing right now. Now, we do have some mixed signals with PPI, although I think the headline is nice and it makes sense. March PPI inflation was revised higher from 3.3 to 4%, and core PPI up to 3.4%. So you did have March that got a revision to go higher. I guess that could be another reason why the bond market is selling off, because people are still thinking, hey, there are some issues with the broader producer price index in regards to how March was calculated, and maybe April gets recalculated again to the upside. One of the reasons I think April was down is because, again, we do have some of this tariff volatility, which probably increased prices, which lowered demand. So it potentially led to people not spending as much. But from that perspective, you got a little bit of mixed data from March, some really good headline data in April. And I guess the market right now is just trying to figure out what is Jerome Powell and the Fed ultimately going to do to make sense of this. Unfortunately, if the Fed is waiting for massive unemployment, by the way, initial jobless claims came out this morning as well, and they came in at 229,000 versus 229,000 expected, which is good, right? We're having jobless claims that are still well below recession expectations, but it's not good for rate cuts, because it looks like Powell wants to see hundreds and hundreds of thousands of people file for unemployment before he decides to cut rates, which, you know, by the time you cut rates at that point, it's already going to be a bit of a mess. So on the PPI, again, it fell by 0.5% in April of 2025. This is the largest drop since April of 2020, and it was the first decline in PPI since October of 2023. So not only did we get our first decline from PPI in over 2 years, but it's the sharpest version of that drop, again, negative 0.3 versus 0.4 expected in terms of the monthly on core since April of 2020. So you got the labor market that's not really that weak, which is kind of hard to justify cutting rates, but you got inflation that seemingly is coming down from a PPI perspective. We had CPI 2 days ago, and that came in against expectations at 2.3 versus 2.4. I think the risk in this economy is towards not cutting rates versus cutting rates. That's what it feels like, versus letting a potential recession take place and then deciding, oh, it's time to cut rates because, like, yeah, people are losing their jobs. 10-year right here, 4.526, going negative just now after being positive after Powell spoke. Can Powell be blamed if the U.S. enters a recession? I think if the stock market is up and the labor market is relatively stable, yes, this will be Powell's fault. Because again, the way to get the labor market to not be stable, the way to get stocks to fall, and the way to get people to get not excited to engage in the process of investing in equities, aka risk off, is to have a full-on recession. And a small recession is not going to be as violent. But if we get into a point where, like, sentiment really goes down the drain in regards to the overall economy, people are going to be wondering why. And I'm sure there's going to be some people that blame the tariffs. But if you get that tariff volatility to come down and most of the tariff rates get walked back, then the whole idea that Powell was not cutting because he was so afraid about the inflation that was coming from tariffs, that's just not going to be bought by the American people. In fact, we do have some new data today. The effective tariff rate in America was 24% in April of 2025. Today, May 15th, It is now 14%. This is based on all the different negotiations, pseudo trade deals, and obviously the big China reductions that we've had over the past couple of weeks. That effective tariff rate has come down from 24 to 14. Now, it was at 4% before we had all of this trade war, reciprocal tariff stuff. So it is still significantly higher than what it was before, but it's also lower than what the market expected it to be over the course of the month of April when we were unleashing all these Liberation Day tariffs and reciprocal tariffs. If this thing goes from 14% to like 7% over the course of the next couple of months and we don't get a cut, I think Jay Powell is going to be the one who's blamed here, at least in the short term. So from that perspective, hopefully we get a rate cut soon. I think it's going to be hard to see if we get it. Basent is probably really annoyed because we've got to refinance $9.5 trillion of debt. And that debt, if it doesn't get refinanced soon, we're going to have some. I mean, we can pay the 4.5% interest on it. It would just be, our kids are going to be paying that interest. And so if we can get that to at least be 3%, 3.5%, 3.8%, that would be saving hundreds of billions of dollars. But it depends on Powell. And as of now, it does not look like Powell currently wants to cut. Yeah, this was one of the important lines that Powell said, appropriate to reconsider the average inflation targeting. I still think they have 2%, right? That's going to be the core inflation target. I mean, they're not going to be deviating from that. And we are pretty close at 2.3. But the question becomes, how much do the tariffs actually have an impact on that average core inflation weighting that they're looking at before they end up making this decision? He wasn't really hawkish. He wasn't really dovish. He just said nothing today. And because he said nothing today, I think there's nothing for the market to be able to expand in terms of analyzing what he ended up saying. We do have a lot of people that said a bunch of other things. Good morning. Thank you, everybody, for being here. We've got a lot of updates and a lot of headlines to look at. So let's start getting into all of that right here. We do have some famous fund managers that are warning about a recession, warning about stock prices. We had Trump that said a bunch of things today. He's still in Qatar right now. We had Walmart earnings, Alibaba earnings. Walmart actually said some interesting things about the state of the consumer. So we're going to get into all of that as we get into the market open. And we analyzed Powell, but there wasn't much to say for Powell. So I went live early today to see what Powell had to say. Didn't say much, but we've got a ton of other stuff to get through going into the day. So thank you, everybody. Good morning. Thank you for being here. VVV, thank you for the $99 super chat. Appreciate you, brother. Again, you've got everyone in the chat guessing who is Triple V. Triple V is a cool name, right? VVV, Triple V. Thank you, brother. Good morning to you. And thank you for the $100 super chat. VVV is subsidizing it with all this money printing. Absolutely. He's absolutely subsidized me. Thank you, Triple V. Appreciate you being here. And thank you, everybody, for being here on the show. All right, so let's get into it. I think let's start off with let's start off with some of these Trump comments. So here's two things that Trump said this morning, or actually three things. First on, here's what he said when it came to the trillions of dollars of investments that the United States has raised.
We've raised trillions of dollars in investments. There's never been anything like it. And just to finish, we have a country that now has, I think, Howard, we can say that at least $10 trillion of investment and potential investment. And if the past administration did $500 billion, it was like a lot, but we did it in 2 months because it's actually a little more than 3 months. But I always say the first month I had to get a little bit acclimated. So I didn't really do this the first, but when we started, so we've really been doing it, Susie, right, for 2 months. So in 2 months, we're going to have over $10 trillion. No country's ever come close to that. We've raised.
Okay, so obviously President Trump has been able to get a lot of deals done, been able to get a lot of money. Qatar purchased $200 billion of Boeing jets yesterday, or they got into an agreement to purchase a couple $100 billion of Boeing jets. So we are bringing money back into the United States. Remember that report I showed you guys a couple days ago around Bloomberg reporting that NVIDIA may be able to sell 500,000 chips to the UAE every year till 2027 based on the repeal of the diffusion rule. That news seems to be confirmed today. The White House hasn't officially confirmed it, but from all the sources I'm looking at, it looks like NVIDIA is going to be able to spend a lot of money or be able to get a lot of money by sending a lot of chips to the UAE, which will obviously bring over a lot of investment to the United States, pay for a lot of jobs, et cetera, be good for shareholders and the AI trade. So from that perspective, yes, there's a lot of money coming into the United States. Yes, there's a lot of investments. And that's a really good thing for all of us as citizens and for the global economy, especially all of us who own stocks in the United States. However, we've got a lot of debt, and you can tell Trump's starting to get a little worried about the current 10-year rate based on how he answered this question about the sovereign wealth fund in Qatar.
Well, look, Howard likes the idea. I'm less. I want to really make a lot of money, pay off debt, and just get it, and then you do it the fund. You know, these people have no debt. It's nice to have a fund. I say to Howard, we're a little early because we have debt, and really, it sounds like a lot, but relative to the kind of income and everything that we have, it's not really that much. But it's still a lot. And I'd rather pay the debt off and then do the fund after the debt's paid off. And, you know, to me, the fund is just pay off debt. We're making a lot of money. We had a situation 6 months ago. We were losing $5 billion a day on trade. Now we're making money on trade. Don't forget, we were losing $1 trillion to China. So we essentially went cold turkey with China for a period of a month. Therefore, we weren't losing $1 trillion. You know, I think that's pretty simple, Scott, right?
You guys have the funniest comments on who Triple V is. You guys legit have the funniest comments on who Triple V is. But listen to what Trump is saying there. It's a totally different tone from January or early February when he signed the executive order for the sovereign wealth fund. I was covering it on this channel. I remember how it went. Everyone was super excited because Trump was like, hey, we're bringing a ton of investment into the United States. Let's sign the sovereign wealth fund. Let's start investing. We'll put TikTok in the fund. Like, he had all these different ideas on how the United States could increase essentially the balance sheet of the country by making these investments. Now he's like, you know, I'd love to make some investments, but Qatar doesn't have any debt. That's why they're able to pump all this money into their sovereign wealth fund. The United States has $36 trillion in debt. And we got to pay off some of this debt. And I think Trump's also talking about this because he's looking at this 10-year spiking. Again, it's not really turning into a credit crisis yet, but eventually we need to deal with this. And it could turn into a credit crisis if we have some more macro issues. But inevitably, we've got to deal with this. And I think Trump's looking at this like, wait a second, I got $9.5 trillion I have to refinance in the next couple months. I can't worry about creating some sovereign wealth fund and then deploying capital when we have all this debt. Even if that capital could create more capital, but investments take time, right, in order for them to pay off. So this debt is coming due. The only way we can meaningfully resolve some of this debt is either for Powell to cut rates so we can refinance it at a lower rate, or for us to just massively grow. And the growth stuff just takes some time, which means Powell's got to cut rates soon. And Trump knows that, but he also knows that Powell's not going to give him any rate cuts right now. So from that perspective, I think he's starting to get a little concerned about how do we navigate this? And it's fair to be concerned around that. Basent, I think, has some plans up his sleeve. And maybe one of those plans, which Kris has been talking about on the show for a while now, which I think is going to be probably one of the only other ways besides Powell cutting rates for us to be able to actually get that 10-year to start coming down, is a reduction of the supplementary leverage ratio, SLR regulations. Trump is preparing a major rollback of bank capital rules tied to the SLR, one of the most significant cuts since the post-2008 reforms, per the Financial Times this morning. Now, what is this? In a nutshell, it basically allows banks to buy more treasuries without the regulatory concern of how they were subsidizing and quite frankly, collateralizing a lot of their debt in 2008, which created issues with the subprime mortgage crisis that we had. This move would lower the required cushion of high quality capital large banks that would hold against total leverage, including treasuries and derivatives. It comes amid lobbying from the banking sector, which argues that the current SLR punishes lenders for holding low risk assets and limits their capacity to support liquidity. Bank of America, JP Morgan, they want to own treasuries. They want U.S. debt because it's money that theoretically will never go bankrupt. It's something the U.S. would never default on, and they're kind of guaranteed that 4%, 3.5, 4.5% rate that they agree to when they buy that debt. And we want them to buy our debt because when you buy our debt, our yields come down, which means the cost of capital comes down for the average American that wants to get a mortgage on their home. So I think Scott Basent right here is going to be pivotal in being able to get this law passed and make it official. Regulators may present proposals by the summer, with Treasury Secretary Scott Basent calling it a high priority. The plan could include exempting treasuries and central bank reserves, a change that during the pandemic freed up $2 trillion in balance sheet space. It's almost like quantitative easing, but not the Fed buying up treasuries, but rather banks doing it. And again, that's not like a perfect thing to do. We had a lot of issues in 2008 with banks being over leveraged with the amount of treasuries that they had, especially, this is why Silicon Valley Bank failed. If you have a ton of treasuries and then rates go up, and then you're collateralizing against your treasuries and you're lending against your treasuries, but you're lending at 2% and then rates go to 3.5%, like that 1.5% on hundreds of billions of dollars is a lot of money. And Silicon Valley Bank, First Republic, they were not able to survive in March of 2023 when that played out. So I think it's necessary right now because there's got to be some way for us to get rates down, but it's not like it's the perfect solution. It's just one solution until Jay Powell, hopefully ends up cutting these rates. So that's what we've got going on in some of the macro when it comes to inflation. On top of that, here's another reason that Trump's not the happiest camper this morning. Not only do we have a lot of debt and that 10-year spike into 4.5, he's also a little upset at Tim Apple.
Apple, as you know, is coming in. And I had a little problem with Tim Cook yesterday. I said to him, Tim, you're my friend. I treated you very good. You're coming in with $500 billion, but now I hear you're building all over India. I don't want you building in India. You can build in India if you want to take care of India, because India is one of the highest tariff nations in the world. It's very hard to sell into India. And they've offered us a deal where basically they're willing to literally charge us no tariff. So we go from the highest tariff, you couldn't do business in India. We're not even a top 30 in India because the tariff is so high, to a point where they have actually told us, I assume you too, Scott, you were working on that also, that there will be no tariff, right? Would you say that's a difference? They're the highest and now they're saying no tariff. But I said to Tim, Tim, look, we've treated you really good. We put up with all the plants that you built in China for years. Now you got to build us. We're not interested in you building in India. India can take care of themselves. They're doing very well.
Okay, well, Tim Cook is definitely interested in building in India, even if Trump doesn't want them to build in India, because the cost of labor in the United States is significantly more expensive by a factor of minimum 5x, if not 7 to 8x, to build an iPhone. So again, maybe this is why Tim Cook didn't go to Saudi Arabia. Maybe he didn't want to talk to Trump because he knew that he is now deploying plans to shift a lot of their manufacturing from China to India, and Trump actually wants them to come to America. But I don't know if Tim Cook knows how to tell Trump that it's just going to cost them way too much money to build the damn phone or the MacBook or the iPad in India, and American consumers will have to pay for it. Like, if it costs them way more to produce an iPhone, they're not going to sacrifice their profit margins. And if they do, you can kiss Apple stock goodbye, which, by the way, is not good for America either, because Apple stock is in pretty much everyone's 401k, and it has been for years, right? So you can't have Apple collapse. It's a tricky situation. It's a tricky situation. Trump wants more American jobs. He wants the perception of America first when it comes to manufacturing. But with companies like Apple that have a very complex and nuanced supply chain that has really never been oriented in the United States. A lot of their marketing and design happens in California and the United States, but not their actual manufacturing. So the ongoing saga between Apple and Trump, Apple right here down about 1.07% in the pre-markets. I think we'll have to see how it plays out. But, as of now, it's not like Tim Cook is necessarily on Apple's best side here today. So those are some of the core macro stuff that we're dealing with in the pre-markets. For those that are just joining, thank you for being here. CPI again came in at 2.4 versus 2.5. Core PPI, not CPI, PPI. Core PPI came in at negative 0.4 versus 0.3. Again, it looks like it's time to cut rates. The question is just going to be when, and hopefully soon. Hopefully soon it plays out. The 10-year dropping a little bit right now, 4.53 to 4.487. Maybe some big buyers just stepped in and bought some treasury funds right now, but that is a nice little bit of a move. We saw 4.53 down to 4.487. If that 10-year keeps coming down and the market continues to do what it's doing, we really will be in that golden age that Trump is talking about. But this metric right here is, I think, stopping from that golden age from really being unleashed, because unfortunately, it's like if you have a cavity, right? And you enjoy like eating, you have a big sweet tooth and you enjoy eating, cakes or cookies or whatever. And like, you're enjoying the process of eating it, but then you realize I have a cavity, and like, it kind of hurts to eat it when you have the cavity. Like it's amazing to see the stock market do well, but it's also like, that doesn't stop the issue at the structural issue, which is that we have a lot of debt. And until we figure out how to resolve that debt with lower rates, we're going to continue to have the bond market get a bit more scared about what's going on in the markets. So that's what we got right now. Google's up a little bit in the pre-markets. Let me see if there's a Google headline. Where is Googs? We were at 165 yesterday. We are at 167 right now. Yeah, 166.3. Are we heading to 170? We have not seen 170 on Google since earnings, and we got it on earnings for like 2 seconds, and then it went back down. So Google kind of being a little bit of a contrarian trade right here. I don't see any core headlines, but obviously Google is still severely undervalued if you believe in their growth rates. One headline from yesterday, Google-owned YouTube just announced a new Gemini AI feature to target ads when viewers are most engaged. Okay, so a little bit more better ad targeting on YouTube via Gemini's AI models. But outside of that, I don't see any core headlines that are causing Google to go up. It is one of the only stocks that's green right here. A lot of stocks are red currently in the pre-markets. Okay, let's talk about UNH. Let's talk about UNH. This one is ugly. This one is ugly, folks. So last night, an article came out by the Wall Street Journal, and they said the United Healthcare Company is going to be investigated by the DOJ on Medicare fraud. What does Medicare fraud means? Well, it means a lot of things. And one of the main things it means is that they were price gouging a lot of Medicare recipients. Remember, Medicare is subsidized by the government. So there's a lot of, that's why the DOJ is getting involved, because essentially they're stealing money from the government. And one of the things we talked about yesterday is that the UNH dip is only buyable if you have a 5-year trajectory and believe that eventually a company that's like one of the top companies in the Dow Jones has the cash flows and the market dominance to be able to recover, which it probably does. But it's not a buy in the short term because there are skeletons in their closet. And these skeletons, based on Trump's new executive order and everything going on in the media, could definitely be unveiled, which would get people to really question how ethical is this healthcare company. Now, having said that, that article came out yesterday, but then the article was proven to be false. So it was a wild day yesterday. UNH responded and they were like, we have not been contacted by the DOJ for any investigation. They said this right here. We have not been notified by the Department of Justice for the supposed criminal investigation reported without official attribution in the Wall Street Journal. The Wall Street Journal's reporting is deeply irresponsible as it admits that the exact nature of this potential criminal allegation is unclear. We stand by the integrity of our Medicare Advantage program. Regardless of the news is true or not, this is a stock that is just going to be so affected by headlines over the coming months in regards to the healthcare sector. And it's down 8% after being down 17% yesterday, after being down 20% in December. So if you look at a chart on this, it's pretty incredible to see this. It was trading at 625 November 2024, gaps down all the way to 483 in December. Then it recovers back to 544, comes all the way back down to 449 in February. Then it is the best performing stock when NVIDIA, Palantir, Tesla, Robinhood, all of them are falling 30 to 40%. United Healthcare is kind of the flight to safety, gaps up all the way back to 600, then comes down to 436 after the reduced profit outlook guidance in April. And then you get all the investigation and Trump executive order news that came out over the past 3 days. And now it's down to 282. This stock is down 50% year to date. And a company like United Healthcare should not be falling 50%. I mean, it's a staple of the Dow Jones. So very, very wild experience for that stock. I know a lot of people on Twitter yesterday, I was reading some posts, they were getting excited to buy the dip at around 350, 370. And you kind of can't blame them because it's like, dude, it's down from 650 to 350. Like at some point you think this company's not going out of business. That's a dip you buy. But the headlines are just so ugly. The headlines are just so ugly. And as a result, it took this one down to 283. I think if you own it, you shouldn't be afraid. You shouldn't be scared. Like this one will recover over time. And it's not something you have to like sell out of because you're so afraid of what's going to happen to the company. But new capital being deployed against this, I just think there are other opportunities. Now, granted, if this thing falls below 250, that's when I think a lot of big money is going to start to get excited about it. But if the headlines are true and there really are some Medicare frauds that's going on with UNH, you might have big money that ends up staying away. Bill Ackman, he doesn't short anymore, but back in February, he put out a long tweet and he said, I think that United Healthcare is frauding a lot of their patients and they're subsidizing that fraud by using the government's Medicare Advantage program. And he called on this thing to fall 50%. He didn't actually, I even asked him, I said, hey, are you short? And he commented against my reply and he said, no, I'm psychologically short. And I was like, well, maybe he should have been actually short because, dude, he called it. He absolutely called what happened. And based on what we're seeing right now, United Healthcare has taken a nasty 50% dip. So anyone who did have shorts around this one has benefited, but I think this one is going to take some time to ultimately recover. Walmart earnings. What do we got on Walmart? This is one of the biggest companies in the United States, one of the biggest employers. EPS, they beat by 5%, 61 cents versus 58 cents expected. Revenue, they missed very slightly, 165.6 versus 165.63. Revenue is up 3% year over year. EPS is up 2% year over year. NVIDIA is growing over 50% year over year. Walmart's growing over 3% year over year. And Walmart is still more expensive than NVIDIA. So take that with what you will. But yeah, look, the earnings weren't that bad. Obviously, a good EPS beat and came in line with the revenue estimates. However, the CFO is warning that based on these tariffs, we might end up seeing some price hikes going into the month of June.
Just reporting and quarterly results. Let's get to Courtney Reagan. She's back with us. We got the numbers.
Hi, Joe. Yeah, so Walmart reporting first quarter adjusted earnings of 61 cents per share. That's above the 58 estimate on revenues of 165.6 billion. That one's slightly below consensus of 165.8 billion. Now, the U.S. same-store sales, those rose by 4.5%, also above expectations, driven by health, wellness, and grocery. Continued share gains in grocery, also noted in the release. Now, net U.S. e-commerce sales grew 21%, and this is notable. This is the first full quarter where e-commerce was profitable. Walmart had said it was on track for profitability at its investor day. It does indeed look like it happened. Now, the retailer affirming annual guidance just as it did at its investor day in April. Walmart also forecasting second quarter revenues to grow between 2.5% and 3.5%. But Walmart is not giving guidance for second quarter operating income, due largely to the wide range that it would have to give because of the tariff impact on its accounting method. This is a little wonky, but I spoke with CFO John David Rainey, who explained that Walmart uses the retail method of accounting, which uses a cost to sales price ratio, which then is very hard to predict narrowly with tariff rates changing wildly. So Rainey says the quarterly fluctuations are going to make it really difficult, but thinks that over the year, it'll even out. So it's holding its annual operating income estimate. He explained that we import 1/3 of what we sell in the U.S., China, and the largest, of course, is China, then followed by Mexico, Canada, India, and Vietnam. He also said we are pleased on the progress that's been made by the administration on the tariff levels that were announced in April, but they are still too high. We will absorb some of the price increases, and suppliers will too, but consumers are likely to see some price increases, and that concerns us. But Rainey.
And that's another reason why Jay Powell needs to be cutting rates, because although prices will go up, if that creates enough demand destruction, it should be offset by some level of deflationary impacts by people just not wanting to pay those higher prices. And as a result, you enter into an environment where if PPI is negative for the first time since 2020, we probably should be thinking about at least reducing somewhat of the federal funds rate. But you got Walmart CFO right here saying, look, these tariff rates in China still aggressive, even if they're down from 145%. And we're probably going to have to increase some of the prices on our goods.
He said managing inventory is really going to be what sets retailers apart in this environment, noting, quote, we have not canceled any orders with suppliers. We have reduced some orders on occasion. Now, Rainey says consumers right now are discerning, mindful, maybe a little concerned about possible looming price increases, but their behaviors have not changed. I will speak with Walmart CFO John David Rainey in a First on CNBC interview on Squawk on the Street about.
So that's what you got from Walmart. And then on top of Walmart, we had Alibaba that had earnings. They missed by 3% on EPS, 173 versus 178 expected, missed by 2% on revenue, 32.5 versus 33.2. They did say their AI revenues are up 7x year over year. So although their top line revenues have a small miss, Alibaba's stock right here is down about 5%. Markets seem to not like it. Their overall AI business is growing dramatically. And so that was one thing to be excited about in terms of Alibaba's call. Again, there's a lot of innovation in China going on with different AI data centers. They need better chips. NVIDIA can't sell to them yet, so there can't be as much innovation as they would like. But nonetheless, their AI business is growing pretty dramatically, including their cloud business. Top line metrics were a little bit of a miss. And that's what you got for some of the biggest earnings this pre-market when it comes to Walmart and Baba. UNH still taking a dump right here in the pre-markets, down 8.85%. It was at 283. Now it's at 281. Yeah, this one's nasty, dude. It kind of feels like the perfect example of a falling knife. I mean, like the definition of a falling knife, in my opinion, is when a stock is falling and people are jumping in, but there's no headline to save the stock. There's not like there's a horde of dip buyers that understand the intrinsic value of the company and are betting that the market's being irrational and stupid at the moment. And as a result, they're buying. This is one of those things where you could say the market's being stupid right now. Maybe, over the next couple of years, this will look stupid. But in the short term, in terms of entry price, the market's just reacting to some really, really negative things. And it's not like there's any positive things that are on the horizon. Having said that, I would not be surprised to see it reverse because it's down 50%. At some point you would think dip buyers get interested. But if the headlines are going to keep getting negative, and what if there is a DOJ investigation? Like United Health responded to the Wall Street Journal article yesterday saying, we have not been contacted by the DOJ for an investigation. But what if they do get an investigation eventually? UNH now down 9.3%, continuing to fall right here. What if eventually there are some legal things they have to deal with? I mean, how do those headlines justify any excitement in the name, even if it's down 50%? So from that perspective, I don't know if it's a short because you kind of missed the short. I mean, the short was like 50% ago or even 20% ago. So I don't know if shorting it right here is the easiest thing to do, but I definitely don't know if it's a buy either, especially when there's so many other opportunities currently right now in the market. Tesla right here at 340. That's down about 2% in the pre-markets. Nvidia is down about 1%. Palantir down 1.6, and then Robinhood down 1.73. It looks like it's going to be a rather red day across the board. I don't think that's crazy given how much green we had over the past couple of days. CoreWeave had a really nice earnings. CoreWeave up 3%. One thing about CoreWeave, though, it was up 12%, then it was down 6%. Now it's up 3% in the pre-markets. CoreWeave is going to be spending $3 billion of CapEx in Q2. They're going to probably bring in about $1.2 billion of revenue in Q2. So they're spending 3x the amount of CapEx versus revenue, which is pretty dramatic. That was not announced on the press release yesterday when the earnings came out, but it was talked about during the call. And that's when the stock went from up 12% to down 6% because the market was like, hey, wait a second. You guys are spending a lot on CapEx. Having said that, CoreWeave's backlog is like $28 billion of revenue that they're going to be able to recognize over the coming years because there is so much demand for GPU reselling, which is essentially what they do. They buy GPUs and they resell them and rent them to people that can't get them from the hyperscalers or from NVIDIA themselves. So CoreWeave, like I have not fully gone through the financials to understand it. I don't know if it's necessarily cheap. I know it's been a successful IPO. The IPO at $40. Now they're at 70. But the AI data center demand based on their earnings looks like it's only going more and more exponential against what people thought it was going to be. And you got NVIDIA right here at 134, gapping up from 115 on Monday, probably because of all the demand that companies like CoreWeave are getting, which aren't even, the true data center plays like NVIDIA's. So exciting to see some of that momentum as well. eToro had their IPO. They had a great IPO. They IPO'd at, I think, $40 or 52, gapped up to 65.70. So they ended up 28% of the day, down about 2% right here. And I don't really think it means much about eToro, the company. I'm sure the company's a cool company. I don't use them as a broker. I'm sure some of you guys do. But I'm just happy that IPOs are doing well because the more IPOs we can get into the country, the more excitement we have for the capital markets and, the more liquidity that ultimately comes in, which would be a good thing for all of us as investors as well. Google is green. I don't have the headline on Google, but they are green. Speaking of Google, 167 right here on Google. Let's talk about some 13Fs and 13Gs that have officially come out. The first one we have, we'll get a lot more of these over the coming days, but the biggest one that we got yesterday has to do with Ray Dalio. Bridgewater, Ray Dalio, he made some buys and sells. Top 5 buys, Baba, Baidu, which is the Chinese version of Google, gold, about $320 million of gold, bookings, and Palo Alto Networks. Top 5 sells, the S&P 500, Google, NVIDIA, AppLovin, and Meta. So you had Ray Dalio say, I'm going to reduce my exposure to big tech. I don't know if this was in the midst of the tariff volatility. We don't know exactly when he sold, but if it was, then maybe he didn't get the best exit prices on some of these names. And increase my exposure to China. So he loaded up in China in gold and he sold off big tech. Now, this should not be surprising to anyone who knows who Bridgewater or Ray Dalio is. He is a avid China bull and kind of America hawk. He was putting out a lot of scary articles and mysterious articles in the midst of the tariff volatility saying that the new world order is here and China is now going to overtake the United States, yada, yada. So he's been heavily allocating Bridgewater's assets towards China to benefit from that. It hasn't worked out as much as the United States because the United States is still the top dog here. But yeah, it doesn't surprise me that he's kind of more serious right now about allocating towards China. Yeah, it has to do with Q1 in terms of his 13F, 13G, but we don't know when he ended up selling exactly, right? Did he sell at the lows of March when things were starting to get really bad? Did he sell at the highs of February? So we don't know exactly when he got out from some of these, because if he sold Meta at 740, I mean, I don't think anyone's going to get mad at him. But if he ended up selling it close to 500 and Meta's at 650 right now, right, maybe the timing of it wasn't the best. And so we'll get a lot more data from these hedge funds in terms of how they're playing and navigating the volatility. But it seems to be affirming the data that we've been getting for a while now, which is that the hedge funds and the institutions are not the most excited to be in the capital equity markets right now, and they possibly have been creating the catalyst that we've seen over the past couple of days in terms of momentum because they're buying back in. In fact, here's a chart from Bank of America that we got yesterday that kind of shows exactly that point. Hedge funds bought global stocks on Monday, which was the day where things really gapped up, at the second fastest pace in at least 5 years. So you can see that red line at the very top of this chart. That is sort of the cap on how fast hedge funds, or the sort of the velocity of which hedge funds and money managers have been buying stocks. The fastest before was around that December 2023 time, and that makes sense because October 2023 we bottomed. So December, you would think 2 months after that, all right, everyone starts piling in. We are now matching that December 2023 level, as you can see right here, which was on Monday, May 12th, 2025, which is kind of crazy, right? And so from that perspective, you have the months right here, and then you have the velocity. The 1 through 5s is basically just measuring the velocity, how much they've been buying. And it's the sort of net trading flow, which is measured on a Z-score. It is the highest it's been since December 2023. So, I mean, look, I think they're loading back up. I think they kind of have no choice but to load back up. You can't be on the sidelines when NVIDIA is going from 115 to 130. And that could also be explaining a little bit of the Google run right now. I mean, a lot of these hedge funds want things that are cheap. What is the one thing that hasn't run in the past couple of days, or really the past month? Well, everything has run. It's Google. And so maybe that is also a prime candidate to get some big money more excited about a stock that has been pretty disrespected, in my opinion, by the broader equity markets. So that's what we've got in the context of some of this hedge fund data as well. Rodrigo says, I bought Google at 154. Yeah, I mean, look, if you bought Google anywhere below that 149 to 155 range, you've done very, very well. And at least so far. Google I.O. is going to be next week. That's going to be a big one. If Sundar can really get the market to get excited about what they're going to be presenting and how they're not necessarily just a search company, but rather an AI search company that has a lot of other moving parts besides just search, then I think the market would hopefully be excited. Foot Locker as well. These guys got bought out by Dick's. Foot Locker right here up 83% right now. They are being bought out for $2.3 billion by Dick's. And this company is now being taken off the table. If you owned the stock at $12 yesterday, you now get to get a buyout at $24. So we do have some more M&A coming back to the States, which is very nice to see. And if we can get more M&A and IPO, that also would not be the worst thing in the world. Amit, do we think Grab can hold $5 today? I hope so. So Grab had a nice close at $5.25 yesterday. Right now it's at $5.14. I think the entire market is a little red right now, so it wouldn't surprise me to see the markets take a bit of a haircut today, and Grab might take a haircut as well. But I'm also curious to see, do we reverse, right? We're down in the pre-markets for the first time in a couple of days. Do we actually reverse? Is there enough appetite to buy the dip from Palantir when it was at 133 now to 128? Or are people just saying, you know what, I'm going to sell at 128 and I'll buy back in when it comes later? Is there enough appetite to buy the NVIDIA dip from 136, which it hit yesterday, to 134, right? So we really got to see how much risk on appetite there currently is at the moment, and if that's actually going to impact some of these stocks, or do we end up getting a red day after 3 pretty strong days of green that we had over the past week? And that's what we got. Thoughts on Chris Camillo saying OpenAI will reach $1 trillion IPO? Okay, so I listened to his podcast yesterday. Dumb Money and Chris Camillo, they are investing in OpenAI. That's kind of their next biggest investment. They're privately investing in it. I don't hate the investment, dude. I don't hate it. I do think the models are being commoditized. However, I also think Tesla right here down about 2%. I also think that OpenAI's growth is just better than every LLM. They are close to 1 billion users. Eventually, they'll figure out how to monetize it. And when you have the users, you have the distribution, you can pretty much do whatever you want. So I can't hate the investment. I think $300 billion is a tough valuation, but ultimately they will grow into it as they grow their user base, and that user base might end up being in the billion. Well, having said that, it is now 9:30, Thursday, May 15th. Thank you, everybody, for being here. The stock market is now open. All right, wake your ass up. Let's get into it. Let's see if we end up on a red day or if we can reverse and go green. Tesla was at 350 yesterday, now at 338. You got a nice red candle right there on Tesla, down about 2.75%. There you go. That's what we have on Tesla. NVIDIA goes red as well, down 1%. Palantir goes red as well, down 1%. Robinhood down 2%, 60.12. Robinhood's going to have to fight to hold 60 today. It looks like it's going to be a little bit of a tougher challenge. But Robinhood right here at 60.07. Where is Rocket Lab, which had a great day yesterday? That was up 10%. That's down about 1.9%, 23.67 after gapping up to 24.50 yesterday. PayPal, 72.60. They partnered with Perplexity. That pumped them up about 1% yesterday. That one is currently down. Palantir, 129.07. That's down about 0.068%. Google, look at that. Look at that. Look at that. Just peak and trough, dude. 167 back down to 165. So pre-market got pumped. Now it's getting a little bit more dumped. Let's see if it can hold on to that momentum. Google right here, slightly green on the day. MicroStrategy is red. Grab is red, down about 2%. MicroStrategy 413. Microsoft at 451. Where is UNH? Here we go. UNH. Oh my. Oh my. That's ugly. Dude, imagine you bought the dip at not only 370, not only 317, not only 294 yesterday, but it was at 285 in the pre-market. Like, you think, all right, at 285. Nope, 272. 272, down 11.7%. This is ugly. United Health is down, and then HIMS is up 1.2%. So HIMS actually going the opposite. It's one of the only growth stocks that I see that's green right now. This was down 5% on the day. Now it is green. The shorts continue to short this one. So this one defying expectations, even with the shorts being as aggressive as they are. But United Healthcare now down 12%. That's ugly, dude. That is pretty ugly. Amit, are you investing into OpenAI? I am not. I am not investing into OpenAI. So, by the way, if anyone wants to invest in OpenAI, it's not that hard. Like, if you're an accredited investor, just go to one of these secondary platforms. The one that I've seen the most is Hive, Hiive. And all you do is submit your tax returns, prove you're accredited, and then you're going to have to pay a premium to buy the shares. But you can get access to OpenAI. It's not the hardest thing in the world. It's just, a question of, do you believe at a $300 billion market cap, they will be worth a lot more eventually when they go public? United Healthcare right here down 13%. My goodness, dude, 268. This one is just disgusting here, dude. This is like, and again, that Wall Street Journal headline was apparently fake. United Healthcare said they're not being investigated by the DOJ, but the market doesn't care. The market does not care. Meta right here, 654, NVIDIA 134, Tesla 340, Hoodie 6021, SoFi back below 14. We do have some SoFi updates this morning based on what Noto said at the conference. None of it necessarily helping SoFi stock at the moment. That one not holding that $14 range, but UNH really the story of the morning right here, down about 14%. Where's the Dow Jones? The Dow Jones is down 0.5%, primarily based probably on UNH taking a bit of a hit currently right now. This is ugly. This is ugly. QBTS. So we got some quantum names that are green. Look at that. Almost at $12. That's up 5.5%. Archer is also green right now. How green are they? They are up about 1%. They were up 20% for the week. I think Adam Goldstein, the CEO, talked about getting their eVTOL midnight to start working with the government and particularly the Trump administration. So they want to start delivering a lot more of those jets to the United States and being an active player in the government. So that may be, based on that tweet, helping the stock right here up 1%. It was up 20% after earnings. Reddit right here, 120 as well. That's down about 3.5%. After being up 12% yesterday. NVIDIA 134, holding on to that level. Palantir 129.60. Dude, Palantir has not fallen below 128 over the past couple of days. Palantir looking like it wants to get back to 130. Even if it falls back to 125, I think most of us would not be that upset, but it's chilling out in that 127 to 130 range. Palantir right here, 129.77. Hoodie just above 60. Meta 65 or 655. CoreWeave is up 1.3%. Iren Energy, they had earnings yesterday. That's down about 3%. Delo's up 21%. They had a great earnings as well. Those guys are green. The VIX is up a little bit. The Qs are down a little bit. IWM is flat, and the S&P 500 is also currently flat. Adobe, is that one green? Adobe is green, back to 400. I think this was at like 370 over the past couple of weeks. So this one getting a little bit of a move, 400.47 on Adobe. Let's look at Oracle. Oracle is down, currently 1%. As well. Nebis or Nebius. I had Sam on the show yesterday on the market close. You guys can check that out We talked about this. We did a big deep dive. He makes a compelling case, trading at 50% cash, lotting parts to the company. It's kind of a holding company with a bunch of different parts of the business, and it benefits primarily off data centers and obviously AI, accelerated computing demand. 36.28. It's up from $18. So I don't know if I would necessarily chase this right now, given it has made an aggressive move from the April lows, but there is a compelling argument on this one if you are bullish on the broader AI sector. That stock right here up about 0.42%. Currently right now. Oklow's pumping a little bit. They had a good earnings. Well, they didn't really have any revenue, but they beat on EPS by 30%. So they're losing less money than expected. That stock right here up 1.7%. It was up 15% yesterday. So that one not doing the worst. Baba, market doesn't love the earnings. AI revenues were good, even though they missed on the top and the bottom line. Alibaba right here, 6.8%. That one is down. The S&P 500 right here, 0.29%. For everyone asking about if Jay Powell spoke already, yes, if you go to the beginning of the stream, he already spoke. He didn't really say anything that affected the markets outside of the fact that we have to keep looking at the data and be diligent on what we think will happen with inflation. But that was not enough for the market to really react in any meaningful way. Apple right here, 211.60. There you go. Hoodie below 60 as well. There you go. Hoodie is below 60. Amazon, it was at 210. Now it's at 205. This is why covered calls are not the craziest idea in this market. Apple was at 214. Now it's at 211. I mean, if you had a hood covered call at 60 expiring tomorrow, and it was at 63 yesterday, and now it's at 59.90, and let's say tomorrow it ends at $60.05, you can roll it out for a cheap debit or for a massive credit, or it ends tomorrow at like 58 or 59.50. This is why covered calls in this market are working, because we are not a full-on rocket ship that just keeps going up and up and up. We are a rocket ship that is taking some breaks as we make the next leg. And you can see right here, hood, rightfully, people taking some profits. Like it's, I mean, if you're a hood investor, this should not worry you. The stock's up from $30 from earnings. It's up from $49. Yeah, people are going to take some profits. So hoodie right here, 59.73. This is why covered calls aren't the craziest strategy in this market. Pouncer right here, 129.20, down a little bit from 130, and then Nvidia down below 134. And now we got some red candles across the board. SoFi 13.60. Yeah, there you go. We are going red, folks. We are going red, at least for now. And the question is going to be, at what point do we stop? Or do we start to see a little bit more pain today? 116 on AMD. That's down from 122 yesterday as well. Does UNH keep dropping? UNH was 265 last time I checked. 259. My goodness. People are just exiting this stock left and right. They are done with this thing. They are absolutely done with this thing right now. This is incredible. This is pretty incredible, dude. 258. Down 16%. Who's buying UNH? Who's buying UNH? The put returns on UNH must be crazy, right? Yeah, the put returns. Let's pull that up. Dude, the put returns must be insane on UNH. I mean, these puts must be up hundreds and hundreds of percents. Yeah, dude. The May 30th puts are up 900%. If you had bought some puts at like 250 or 270 or 280, you are literally up 1,000%. The May 16th puts are up the $260 put for UNH. There were 103 of them that had an open interest before today. Right now, 4,300 of them have been traded, and it's only been 8 minutes into the market open. They are up 15,000%. So the 103 people that had that put open, if you bought it, hopefully you didn't sell it, you were up 15,000% on your money if you bought a 260 put on UNH. Right now, UNH at 259. This is why the derivatives market, when it comes to equities, it could be life-changing amounts of money. Obviously, it's kind of like a lottery ticket. Like you gotta put up a lot of money to bet that a stock will go up that much or fall that much. But if you take that risk, it can be very, very rewarding right here. UNH at 259 currently right now. Dix is down as well, and it makes sense when a company acquires another company. They're paying out a ton of money, so their stock tends to get hit. So Dix right here down about 12%, but they believe that the Foot Locker acquisition will be value accretive to them long term, and the market will probably recognize that value. Robinhood right here, 59.61. Tesla 339.26. Nvidia 133.80. Palantir 128.50. S&P 500 is at 585. Okay, so here's a question for everybody. Here is a question for everybody. What do you think is the next move on the S&P? What is the next move on the S&P? I I'm going to put two choices. Let's go. We're at 5,900, 5,800. Let's do 5,650 or 6,000. Kind of bullish or bearish. What do you think the next move is? 5,650, which is about a 3-4% decline, which I don't think would be crazy. It's relatively reasonable here. Or do you think, you know what, this is a slight little hiccup. This isn't really even a down day, to be honest. I mean, Tesla's down 2%, whatever, right? And we are going much further to all-time highs, or at least getting closer to all-time highs with back to 6,000. So which one do you think would happen first is the question. Amazon right here down about 2.8% currently right now. Nate says, I think the next move is Hims. Can someone ban Nate? How do we take away Nate's mod wrench? Is there a way to do this? Because we need to resolve this issue. Hims right here. Is Hims green? Okay, Hims is not green, but it's barely red, dude. This stock, look, if I was Nate, I'd be talking about Hims every day as well. This has just been an incredible stock. Just incredible. And if you got it in the 20s and 30s, which to be fair, a lot of us had a lot of time to get into the 20s and 30s with Hims. If it stays at these levels, I mean, you're sitting on some good money. So Hims not doing bad at all. UNH, wow, 255, dude. Or 260 now, but it did hit 255. 261 gapped up right from maybe 255 was the bottom, and maybe you finally got some buyers to step in. 261 down 14%. I see some of you guys in the chat saying that you are taking a shot and you are buying UNH. I can't call you crazy for that, but it could also be a falling knife. And that's just one thing that I think we have to remember. Palantir should buy UNH. Palantir has a higher market cap than UNH's market cap is now $239 billion. This was a $500 billion company basically a month ago. Palantir's market cap is $303 billion. You know, Palantir has a higher market cap than Cisco too. And Cisco just put up like 20 billion of revenue or some crazy. Cisco has a $255 billion market cap. Dude, Palantir is Palantir. It's different. She's different. She is just different. This is incredible, dude. All right, 6,000, 59% of you. The Bulls are still winning in the chat. The Bulls are not letting the Bears win this poll. 60% of you say, you know what? We're going to 6,000. We are going to 6,000. We're not taking a pit stop at 5,650. Red Cat had earnings yesterday as well. These guys are up 6.69%. This is an autonomous drone company. So they are currently a bit green. NVIDIA 133, Palantir 128, SoFi 1369, and then PayPal right here 7250. Currently right now. Hims again, slightly red on the day. And you got Palantir that's at 128. What's UNH? UNH is United Healthcare. It's one of the biggest. I think my healthcare is with United Healthcare, if I'm not wrong. So it is one of the largest healthcare companies in the United States. And, you know, I guess the market thinks that they have been engaged in some pretty ugly behaviors with their customers over the past decade. And I think the story is going to be ever evolving. I think we're going to get a lot more information on what's happening with UNH. And again, UNH also has a PBM business, which Trump specifically targeted with that executive order on pharmaceutical drug prices. So all I see are headwinds, but the valuation feels like it is an absolute steal. The question is it a falling knife or is it a dip buy that eventually doesn't have to rocket ship back to 500, but will be resolved hopefully in the next coming months? And you know, that's the question you have to ask yourself if you're buying the dip on UNH. That really is the question for the day. Archer right here getting a little bit more love. That's up 2.4% back to $12. Bitcoin as well going a little bit more risk off, 102.34. Let me check gold. Ray Dalio again bought $300 million of gold. That was disclosed in Q1. Gold's actually up today. So gold is down from 3,500 from a week ago, but it is still currently up on the day 0.24%. Again, PPI came in way lower than expected. And as a result, that got the 10-year to chill out just a little bit. But the market potentially saying we want to make sure this gold trade is not necessarily done in case we do have some more volatility. Again, Trump this morning saying two major things. Number one, he blamed Apple for going to India over the United States when it came to manufacturing the iPhone, which, you know, creates a little bit more volatility in the context of how he thinks about trade negotiations with India. And then number two, he said, I don't want to invest in our sovereign wealth fund. I want to pay off our debt. Those two things are very telling to me that Trump is realizing that the debt might be more important than making strategic investments because the debt is becoming a real issue, especially with 10 years, with the 10-year at 4.5. And then number two, maybe he's not the happiest with how trade deals are going in terms of negotiations with India. And he wants to use Apple as a bargaining chip with India to further reduce their tariffs in order to let Apple manufacture in India, even if they don't come to the United States. So those two things could be some of the core headlines that's creating a little bit of weakness today, along with the fact that obviously people are taking the profits because we've had a really, really green week over the past 3 days. Rivian right here, 15. There you go on Rivian. Rivian right there, up 1.89%. Rivian was $12 last week, so Rivian getting some love. $15, up 1.82% currently right now. Nick says, imagine selling Hims too early. All right, Nick, I get it. We got the we got the trolling in the chat. I did sell my Hims at 40. Okay. It is what it is. I was up 40% in 10 hours. I was like, you know what? I feel like I should take some profits here. Look, I'm happy for all the Hims bulls. I'm very happy. I'm very, very happy. In fact, I am so happy for the Hims bulls that this is my face of how happy I am. This is me. I got to show you guys exactly what I look like when I say I'm so happy after I sold my Hims at 40. This right here. This is my happiness on Hims. So a bunch of you saying I sold in the 30s and 40s. Well, dude, when it was up as much as it was up, it's like, all right, wait a second. Like, it's probably going to come back down a little bit. Like, why the hell is it even up? There was no headline for it to really gap up like crazy, but it ran away from me. So look, it is what it is. I still do think Hims can get to that triple digits. The short float is just crazy, but it is getting a bit extended here just from a pure sentiment perspective. I mean, everyone is wanting to buy Hims. And so I think at some point, maybe you see a little bit of a topping out, even in the short term, just to swell out some of the FOMO that's coming in. But maybe that doesn't happen, And if it does top out, is it going back to 40? Probably not. I don't think it's that easy to go back to 40. Could I see it going back to 55, 52-ish? Yeah, I can see Robinhood doing that as well. And maybe then it's more attractive to get in and sell some of the calls. By the way, the call premium on Hims are crazy. Roy tweeted this yesterday. There is a $95 call for Hims that you can sell in June that's paying you $200 a contract. June 20th, $95 strikes. People are betting that Hims will be $95, which is 50% higher than the current price right now. And they're paying you $200. In other words, you're being paid over $200 to not sell the stock for about a month. And if you do have to sell the stock, you can sell it 50% higher than what you're buying it at right now. I mean, dude, that's just insane. That's just freaking insane. So it's pretty damn incredible, some of the call premiums on this stock right here. Robinhood, 58.91. There you go, below 59. She's fallen. Down 4%. Again, those covered calls printing today. They're not the craziest thing in the world to have as a hedge. I mean, that's my favorite way to hedge a lot of my portfolio right now. Like, instead of selling and being like, I want to time Robinhood and get out at 63 and get back in at 40 if it ever gets there, having a covered call at 65 is not crazy. Having a covered call at 70 is not crazy. If Robinhood falls a little bit, you get to make some of that premium. You can take some of that premium, buy more Robinhood stock. Like, I think that is not the worst way to play some of this macro volatility. Nvidia right here down about 2% below 133, and then pound here 128.41. That's down about 1.37% as well. SoFi 1365. Even Google, that was gapping up in the pre-markets, all of that is gone back to 164.28 on Goog. Amit, is the reason for this drop because of bond yields? No, I don't think that's the case. Bond yields currently right now are a little down. So you could argue that people are selling stocks to buy bonds. That is a reasonable thing to say. I think the reason for the 0.5% drop on the S&P and the 3 to 4% drop on some of these growth stocks is that they're up like crazy since the April lows. Like I hope no one right here is actually concerned about this, right? Like, I would hope no one is actually concerned Hood's down 4% or Nvidia's down 2%. I mean, these names have rallied like crazy. Nvidia was at 95. Hood was at 30. 2 weeks ago, Hood was at 42. Nvidia was at 110. Nvidia was at 110 on Friday. Like, so to me, this is just very reasonable profit taking. This isn't anything structural or systematic. I don't think Trump said anything this morning that would cause people to get that upset about their stocks. I think this is something I expected to happen yesterday, and we actually saw even new all-time highs yesterday instead. This was, an inevitable pullback. And I don't even think this is a pullback. The S&P down 0.5% is not a pullback. We got to wait for at least 2-3% to really say it's a pullback. This is kind of just, all right, people taking some profits. That's it. Now, I think if anyone started FOMO chasing what we are seeing on Monday or on Friday, then yeah, you're probably a little annoyed, but like, you can't really blame the market there, right? NVIDIA can't just gap up to 150 because it was at 130 yesterday. Like, it's going to take some time. It's going to take some time to marinate. This is not 2024. I do not think in 2024, again, covered calls didn't work because every other day, if not every day, we were up at least 0.35%. I think we averaged like 2% every week in the S&P 500 in 2024. And we had some down weeks. We had some August 5th moments that wiped out a lot of stuff. We had Iran-Israel conflicts back in April that wiped us back down. But realistically, we recovered within 48 hours every time. This market's been a bit different, but the recovery has been swift, but it doesn't mean it's a rocket ship every other week like it was in 2024, which I think is reasonable. And that's why you're seeing some red prices currently right now. Okay, what else do we add? Yes, Robinhood's down about 4%. Jasmine says not concerned, just waiting for another buying opportunity. Yeah, and that's another question, right? What is the next buying opportunity, right? Like, that's going to be a really interesting thing in this market. So NVIDIA got to 136. NVIDIA's at 133. Does NVIDIA 125 turn into a buying opportunity? Because if it does, you're going to get a lot of money that, again, pumps in to the equity markets because they missed the run from when NVIDIA was $100. And they're going to say, all right, 125 is my opportunity. But what if 125 is a trap and realistically 115 is back on the way and we get right back to where we were on Monday? Like, this is going to be the choppiness of this market that I think we have to kind of figure out. Obviously, trying to DCA and buy the dip on a strategic way as we go down every 5 to 10% is probably the best way to quote unquote time it. But it is going to be interesting to see where is the market sentiment across the board. Walmart right here down about 4% after their guidance on tariffs increasing prices. It's going to be interesting to see where the sentiment is at every level for how the market decides to come back in. Because again, these hedge funds have a lot of money, but they might get greedy and want a really good, like NVIDIA gets to 125, they might say, all right, NVIDIA's going to go to 120, and then we'll get excited to get in. And then NVIDIA might gap up from 125 back to 135, and they miss it and they have to buy 135, and then that pushes NVIDIA to 140. Like, there can be a lot of different ways that the big money ends up finding a way to maneuver into this. And I'm assuming they would want, to get another 10% decline to really allocate capital, but it might not be that easy to get there. CoreWeave down 6%. That one getting hit as well. And then RedCap right here is up about 7%. NVIDIA 133, Tesla 337. Tesla's down about 3%. Robinhood again 4.3%, and then Palantir 1.67. Where's UNH? Is UNH recovering? UNH is not recovering. 257 down 17% on the day. Ackman is not in UNH. Ackman is not in UNH. He is quote unquote psychologically short UNH, but he is not actually shorting UNH. India working with U.S. in direction of joint statement on trade. All right, so I think when Trump comes back, it will likely be the India deal that is announced. Economic advisor Kevin Hassett said that they do have a deal ready as soon as Trump comes back. I think he comes back on Sunday. Hopefully Monday morning we get like some understanding of what the India deal would look like. But I think that's going to be the first one before Japan or South Korea or anything like that. Amit, can you touch on ASST coming back to earth after a major pump on Bitcoin Treasury merger news? Yeah, so this is like the pseudo SPAC that pumped heavy after unveiling their Bitcoin Treasury plans. This one's down about 3.4%. I mean, this one is the same. This one is Vivek's fund, actually. This is Vivek Ramaswamy's fund that pumped like crazy last Friday. Kind of similar to CEP, which is Jack Mahler's fund. That one down from like the $50 range to the $30 range. It's another Bitcoin holding company. I mean, look, a lot of these assets are heavily leveraged against Bitcoin. So realistically, the price of Bitcoin determines pretty much how they're going to trade. Jim Chanos, a notorious short seller, went on CNBC yesterday, and he said he's selling MSTR and he's buying Bitcoin. So he believes in Bitcoin, but he thinks MSTR is, in his words, ridiculous. And he feels that the premium to net asset value is insanity, and he'd rather just buy Bitcoin. So you do have some short sellers that are going on the offensive when it comes to the volatility on a leveraged Bitcoin asset like an MSTR, and they're just buying Bitcoin instead. But a lot of these Bitcoin names are red currently right now, including SEP. Why SoFi down 3.5%? Okay, so I don't really know why SoFi is down 3.5%. I think it's down with the broader market. However, we did get some news from Noto. So Data-Driven Investing, who is a big SoFi bull, tagged me in a post this morning. And this is what he said. He said, SoFi CEO Anthony Noto confirms what Amit has been preaching about Hood for several years now. UX matters, especially in the brokerage. Noto said, it's also highlighted to us to look at iteration we have to do on the user experience on discovery with an invest to bring those things to the forefront. So you'll see a lot of changes in that regard. But because there's such a selection, it's sometimes hard to find. And we find that the more that we spend on improving the user experience, the more engagement, the more net flows that we get, the more that we benefit. So Noto kind of acknowledging that, we need to focus on user experience. I think it's good that Noto's acknowledging this, but I have zero faith that SoFi is actually going to build a meaningful user experience. Like, I just do not have faith that this company understands what it means to build a meaningful product. I just don't. I still think they're undervalued. I think their fair value is closer to 20, but I don't think they have the tech talent, and I don't think they have the tech culture to obsess over every little detail in a product. Like when I was at the Robinhood Gold event and I was speaking to one of their core product managers, he was showing me Robinhood strategies. Literally, he wanted me to like touch the screen and feel the haptics, which is like the vibrations of switching from one stock to the next. He was like, that's pretty cool, isn't it? And like that's how obsessed these guys are with the user experience. I don't think a single person in SoFi gives a shit about how the haptics of touching a screen and the vibrations feel to the user. And quite frankly, when it comes to a B2C product, you've got to be that obsessed when it comes to user experience. And so I just don't have enough faith that SoFi is really going to build a meaningful user experience when it comes to invest. But I think Noto is realizing the reason people are going to Robinhood is because they actually have an experience that people, like to use. So, by the way, I'm in Robinhood strategies right here. I put in $1,000 in this thing. So this is what it looks like for those that haven't seen it. Robinhood strategies. I put in $1,000. It's managing my investing, and they have me invested in a bunch of stuff. I'm a shareholder of Netflix, Meta, DoorDash, Costco, Visa, Progressive. I got a little bit of Palantir, Broadcom. So they invest you in just a lot of growth, and they put you in a bunch of different ways to look at it. This is kind of what the haptics things look like. But it's really interesting because, again, there's all these different things they put you in, and it's up 2%. Over the years, the question is kind of just like where it turns out. And this is one of the features they have right here, where it's like, so here's the future projections. If you put in, $15,000 every other month or something, this is what it shows you what your future projections can look like, right? It's like just really cool stuff that is so oriented around the user. And it's one of those things that, again, just creates a really good product when you're navigating it. Speaking of another company in the crypto space and brokerage space, Coinbase got hacked today. Coinbase down about 5.39% after being up 20% yesterday. Coinbase got hacked, and the ransom on the hack is demanding $20 million in Bitcoin. And Brian Armstrong had a message today and basically said, hey, we're not giving you guys any money.
Hey, everyone. I want to make you aware of a disturbing email that we received recently at Coinbase. It was a ransom note demanding $20 million in Bitcoin in exchange for these attackers not releasing some information they claim to have obtained on our customers. Now, we like to do things transparently here at Coinbase, and so I'm going to respond publicly to these attackers by saying, no, we are not going to pay your ransom. In fact, I have a few next steps in mind that I'm going to share at the end of this video.
So Brian Armstrong is obviously not going to be able to pay this ransom. I don't know how they're going to resolve this. He did say that it's less than 1% of their user data that could be compromised, but this is, part of the crypto world. You have to be able to navigate the fact that there are some very malicious actors that obviously will want to take advantage of people as well. By the way, it's not $15K a month. It's $15K a year. I meant to say $15K a year. So if you do $15K a year, that's what the projections look like. It could, be worth upwards of, this one is showing me 400,000 over 30 years, but yeah, not 15,000 every month. That would be nice though, to put 15,000 in every month and just, let it compound. That's an easier way to compound your assets. But in terms of Coinbase, yeah, like it is interesting how they got that data. Brian Armstrong talks about the fact that their customer support teams in Europe and across the world were identified by hackers and then were bribed by hackers to compromise some of this data. And so Grab right here down about 2.48%, Tesla 337. It seems like the hackers figured out a way to infiltrate the customer service representatives at Coinbase, get them to give up some of the data. They don't have that much access to customer data, but they still have your name, your address, your date of birth. Like they have some really important stuff, even if they don't have your crypto key and your wallet address, which obviously if the hackers could get that, they could just steal all your Bitcoin. So still pretty sensitive stuff. And this is why the security around these products is also really important when we think about what it means for the broader crypto industry. Seems like an inside job. I think there's definitely going to be an investigation on it pretty soon, and we'll find out how this plays out. But yeah, that's not the best thing in the world for Coinbase. The good thing is at least it's, a very, very small percentage of users. But yeah, if this headline happened on Robinhood, dude, we'd be down 20%. Because people already, believe Robinhood is one of the scummiest platforms and Vlad's trying to steal your money in GameStop. I mean, I know a lot of you guys don't believe that, but there's a lot of people that have not left that Robinhood GameStop feeling over the past 5 years. And so if Robinhood were to ever have a user data breach and Vlad would have to go on TV and start talking about what happened, I mean, I love Vlad, but if you watch those 2021 interviews, he sucked. He sucked, dude. He could not explain what the heck. I still don't know exactly what happened. Like, I listened to him and I'm like, that doesn't make any sense. Like, what are you talking about? Like, he just sucked. That he was not good at communication. And every time he talked, it just made things worse. And every interview would be like, wait, what do you mean by that? And he would start explaining it and everyone would still be confused. So if he had to do that again, I think he's a better communicator now, but it would not be pretty. So we got to hope that something like that hopefully never ever happens to Hood. Now, it would be a good dip because, I mean, like, give us 20% down on something like that. Like, I think, we can easily overlook that over the long term, but it would be ugly in the short term. Baba right here is down. Baba's down 7.5%. Baba taking a beating right here on earnings. I didn't think the earnings were that bad. I don't know why the market's that upset at Baba here, but they are not giving it any love. Celsius right here. Celsius is at almost 40, 39.37. That's up 1% as everything is red. HIMS goes red. HIMS was at 61. Now it's down 4.7%. So HIMS is red. And then ELF right here, 1.26%. Palantir, 128.15. Still holding on to those levels. QBTS is at all-time highs. Wow. Look at that. D-Wave. Up 10% on the day. Martin Shkreli's short on Quantum has just not worked out. D-Wave getting back to all-time high, or making all-time highs right here. Up about 10%. J-Pow did already talk. He didn't say anything that was interesting. So, yes, he talked in the morning. It was like 8 minutes, and he didn't say anything. So there's nothing really to analyze there. Okay, cool. So that's what we got in the context of some of these quantum names. Okay, we have some home builder data. Let's go to that. Let's see what we got there. We did have a lot of macro data this morning, but let's take a look at home builder, and we have business inventories. Let's take a look at those two pieces of data, and then we'll keep going from there.
485 coming up this hour.
Yes, business inventories. This is a March number, Carl. Expecting a build of 0.2%, comes in at half that speed, up 0.1%. That would be the smallest business inventory build of the year, and it's reverse countdown. 3.3.2.1 are January, February, March. December of last year was down 0.3. So we have been building, but at a slower pace each month. Now we have a May read on National Association of Home Builders Housing Market Index. And for that, we head to Diana Olick. Diana?
Well, Rick, builder sentiment in May fell sharply, down 6 points to 34 on the NAHB's index. This is the lowest since the index hit 31 in December of 2022, which was when mortgage rates first went over 7% post-pandemic. The street was looking for flat. Builders cite growing uncertainties stemming from elevated interest rates, tariff concerns, building material cost uncertainty, and the cloudy economic outlook. They do note, though, that 90% of the responses were taken before the May 12th announcement that the U.S. and China agreed to slash tariffs for 90 days to allow trade talks to continue. Now, of the index's three components, current sales conditions fell 8 points to 37. Sales expectations in the next 6 months dropped 1 point to 42, and buyer traffic dropped 2 points to just 23. Now, 78% of builders reported difficulties pricing their homes due to uncertainty around material costs. 34% of builders cut home prices in May. That's up from 29% in April.
Wow. So it's looking like they need to cut some of these prices to get demand back into the market. Again, you need interest rates to go lower to really incentivize people to say we want to officially buy a home. And until J-Pow cuts rates, you're going to keep having this conundrum in the housing market.
And the highest level since December 2023. regionally on a 3-month moving average. The West and the South saw the weakest sentiment. Those regions are, of course, where we build the most homes. And these numbers are important, guys, because tomorrow morning we get the monthly read on housing starts, and this will likely be reflected in that. Back to you.
Okay, Diana, thank you very much. On top of some other data today, retail sales, let's just pause and talk about that and what it says about the consumer, which was not great for the month of April. The overall headline number, retail sales only grew 0.1%. Big step down than what we got in March. But perhaps not surprising because March, remember, everyone was front running the tariffs. So auto sales really jumped in March. There was some give back on that. If you look at where the weakness was in terms of spending for Americans in the month, sporting goods, hobby bookstores down 2.5%, big drop for the month. Department stores got hit, down 1.4%. We know gas stations were weak. Overall, David, you had 7 out of the 13 categories that are broken down in retail sales actually with a decline. So it's not the strongest vote of confidence in the consumer. And I'll just add one more number, which was the control group, which actually goes into second quarter GDP, was negative. And so that will hurt the, more than 2% growth expected.
This is another reason to cut rates. If retail sales are starting to decline and people are starting to stop spending as much money because of just general macro volatility, weakness in the economy, some layoffs, and then people seeing higher prices. I mean, dude, if Jay Powell waits for a full-on obvious recession and then he says, oh, well, we see the economic weakness in the data and we think it's appropriate to cut. It's like, I wonder how the history books will judge him. I really do. This is a scary game that we're playing, keeping rates this elevated, especially given the fact that it's not like he's looking at the data and it's like, oh, inflation's going up. No, it keeps going down month after month after month. Maybe it's not down as aggressively as he wants to go, but it's definitely not spiking back up. And in some areas, it is going down. We have the sharpest decline since April of 2020 today in PPI on the core. So it's a dangerous game, dude. It's a dangerous game. And eventually he's going to have to make a decision, but hopefully it's not towards the end of the year.
For the quarter at this point.
Not unexpected, though, in some ways, given the volatility and again, these numbers not necessarily reflective of the change in tariffs that just occurred.
Right. So it's too early. I mean, all this data we're getting now, it's like, okay, but we haven't really seen the effect of the tariffs. So for instance, Walmart, which we'll talk to the CFO in a minute, just on Monday of this week, they raised prices on over 1,000 items. Right. So yes, we're seeing some truces and some pauses, but we're still seeing higher tariff rates from places like China. So those baby strollers and those car seats are going to go up in price, and we just don't know at this point how the consumer is going to react to them. And the other thing I wanted to flag, guys, is the rebound in stocks has come along with higher bond yields. And this is something the administration doesn't want to see. It's good that President Trump is watching the market again. He mentioned in Saudi, the market's going higher, the stock market, but look at the 10-year yield. Joe Brusuelas, an economist, this morning sort of circled that at RSM and said, this is a little problematic, right? Because what does it signal? So the stock recovery signals, of course, better trades. Looks like we're de-escalating. Worst case scenarios removed. What does the higher bond yield signal? So the best case scenario would be an economy that's better, right? We're not going to go into recession as much. But they're also, you always, when you watch these bond yields rise like this with stocks, wonder, okay, are they telling us the deficit's going to be a problem again, right? We're not going to bring in as much tariff revenue. We're going to do this tax bill. It's going to drag on the deficit. The deficit, Carl, is rising, even though we have things like DOGE and an administration that's been more.
The deficit is up 23% year to date. We got that data 2 days ago. It is $1 trillion, and we are in the 5th month of the year. So DOGE is really not making an impact, unfortunately. And maybe that is a reason why bond yields are rising. They're just afraid of this looming deficit, even though stocks are higher.
Or hawkish about cutting it.
I mean, Joe's point is that it's mostly, in his words, about economic populism, trade protectionism, which implies higher inflation and rising long-term yields. In his words, the bond market's not buying it. This notion that we're going to escape some of those longer-term frictions.
But you also have to factor in the fact that, they're taking out Fed cuts. June, for instance, has been almost fully priced out, and there's barely 3 cuts priced in this year. So that's an argument suggesting it's just a better mood.
HIMSS down 7%. HIMSS was up about 2%. Now it's down 7%. HIMSS is taking a little bit of a hit. UNH currently right now is down still 17%.
And a better tone about what's going to happen with the economic data. And we haven't seen auctions increase in terms of how much the U.S. Treasury has to borrow, but that's something to watch, in the coming months and quarters, because we're gonna have to borrow a lot, and let's see what this tax bill looks like and how much of a drag it is on the deficit. It's just notable to watch, because remember after Liberation Day when President Trump said bond market was getting yippy, I think was the word he used.
Yes, that was right.
Yippy. And then that a lot of people thought, and he basically attributed to why they reversed. They put in the pause on 90 days. We're back up to those levels.
Oh yeah.
I mean,
It was a
on the
Wednesday
30-year.
night and it was late and we popped to 4.5. That's basically where we are now.
Yeah, 30-year briefly hitting 5%. The thing is, what I'm hearing, it's more orderly than it was then. And it's kind of coming a little bit more slowly. And if it's coming for the right reasons, maybe that's better, which is a better outlook on the economy. We just don't know yet.
Deficit is up year over year, I believe 13%.
It is.
Even despite the cost-cutting efforts and everything else. You're still talking about double-digit increases in the deficit.
Right. And the question is, are they going to be able to offset the tax cuts ultimately?
Right.
So could it go even higher? Are we talking about that? That's, may be problematic. Although, look, it just takes 1 week unemployment report and they just buy treasuries like crazy.
Meantime, let's dig a little bit deeper into that data. Joining us this morning, former Fed Governor Frederick Mishkin. Rick, it's great to have you back.
All right. So, yeah, we are definitely seeing some volatility here in the equity markets based on probably what they were talking about, which are bond yields. Again, it's still, NVIDIA's still at 133. Like, this is just, it's not really a sell-off by any proportional magnitude based on the momentum we had over the past couple of days. However, you do have HIMSS that is now down almost 9%. I don't know why. If anyone can tell me why, I would love to know. This kind of looks more headline driven than technical driven, but it also could be technical driven given it was very overextended on the RSI, for example. But it's kind of falling with some of the healthcare names as well. UNH obviously down 17%. Where's J&J? J&J is up a little bit, and then Pfizer is up a little bit. Eli Lilly had a bad day yesterday. They are recovering a little bit today. Okay, so all the pharmaceuticals are up. The actual healthcare providers are taking a bit of a beating. UNH right here still down 15.9% currently right now. My uncle says, ask Nate. Nate, what's going on, bro? I was, me and Nate are in a group chat, and every day, when HIMSS is mooning, he's like, HIMSS, Amit. What happened to HIMSS, Amit? You didn't listen to me, HIMSS. Yesterday, that group chat was awfully quiet, bro. That group chat was awfully quiet. And at 9 p.m., I decided to send a text to the group chat, and I was like, so Nate, no word from you today, huh? About your beloved HIMSS, given it was down 4%. So, Nate, if anyone can fix this, I think it's you. And, for all the HIMSS bulls out there, I think they would appreciate if you fix this 9% decline right here. Now, even with this 9% hit, HIMSS right here is still up 120% year to date. So I don't think anyone can be too upset. And again, this is pretty, dude, if HIMSS goes back to 45, it would be reasonable. The thing's up a lot. So I'm just messing around here. But I think that the question is going to be, do the shorts double down here and see this as weakness and get excited to take it back down further? Or do the bulls have enough momentum to wend off to the shorts, given the short float is now 35%. It was 33% last week. So the shorts continuing to say that we will double down. HIMSS options expire tomorrow. That's also another argument, right? Yeah, that's you definitely got market makers that probably want to collect some premium on the options market. So, I mean, dude, if you sold a HIMSS $65 call to somebody on freaking, I mean, let's just look at it right now. So the HIMSS $65 call expiring tomorrow. Tomorrow's what, May 16th? May 16th, 65. It was at like 64 the other day, right? So you would imagine, there's 7,777 open calls for 65 on HIMSS expiring tomorrow. The volume that's been traded today has been over 6,500. If I look at what it was worth 2 days ago, it was worth $3.45. Meaning if you had 100 shares of HIMSS, you could have sold a covered call. You could have covered your call with those 100 shares to some gambler, maybe Nate, out there saying, oh, HIMSS is going to go to 65 by Friday. And they would have paid you a whopping $345, which means even if you bought HIMSS at $60 earlier in the week, 345 divided by 6,000, you would have been making a 5.75% return in basically 72 hours. Let me say that again. 5.7% return in 72 hours. Most real estate does not go up 5.75% in a year. Most people in the S&P 500 are happy if they get 10% in a year. You could have made 6% in 3 days, and now that call is worth 33 cents based on HIMSS falling 11%. Which means even if you closed it out right now from 345 to 33, you would have been able to make almost 85% of that 5.75%. So call it about maybe 4.7% on your money in 3 days by selling that crack to the crack addicts. This is why I like covered calls. Now, in 2024, if Palantir was 40 and you sold that, $45 covered call because you thought that guy was a crack addict, the crack addict who bought that call ended up, being right. And he ended up enjoying that crack and he got really high on that crack because Palantir's stock went really high. But this market's just different. And obviously it's very hard to time exactly when things are going to top out. But the point is, if you give yourself enough time, which if you're able to roll covered calls and understand how to navigate the extrinsic and intrinsic value of the contracts, you're probably going to be able to not be underwater as long as the stock is reasonably near your strike price. And so I think that's what we're seeing right now on him. Same thing with Hood. If you sold a $65 covered call to someone on Friday for Hood, when Hood was at 63 yesterday, now it's at 58. I mean, boom, you're probably up 80 to 90%. So, that is one of the benefits to selling covered calls. Kris can't use the F word, but let's talk about crack. Okay, first of all, the F word and the way it sounds is a lot more volatile than saying the word crack, okay? Second of all, Kris said it 5 times in like 5 seconds, and it was getting a bit aggressive. Third of all, it's true. It's literally selling crack or cocaine or heroin, whatever you want to call it, to people that are willing to take some of these bets, dude. And the reason I use that analogy is because it's like, people betting on weekly calls, I don't tend to be in that game. But when you do it, you got to have some balls of steel to imagine that a stock is just going to keep going higher and you're going to get above the premium you pay for the strike, because again, it has to get above that premium on the call for it to even break even, which means it can't just be above 65. It has to be above $68 if you're paying. Like if you sold that call to someone and they paid $3.45, they're not betting it's going to go to 65. They're betting it's going to go to $68.45 because it has to be your strike plus the amount of premium you're paying in order for it to even break even. So it's one of those things, bro, where if you're in a market where things are volatile, but you have certain stocks like HIMSS that are able to generate these crazy premiums because you've got all these drug addicts willing to buy the drugs, you can really benefit off that volatility. SoFi right here. Where is SoFi? SoFi is 1348. SoFi down 4%. Now, granted, SoFi's falling with the rest of the market. I don't think this is just a SoFi thing, but it still is down. Tesla is at 340. Tesla recovering a little bit. No, Tesla's 338. Touch 340, but still back down at 338 right now. Hood's at 57. My goodness, yeah. They're taking Hoodie down today. They're taking her down 5.4%. Again, I think that's reasonable given the run we had, but again, I don't want to sound like a broken record, but this is why covered calls are working in this environment. It's just a hedge against stocks not continuously going up and up and up. Amit Powell is speaking right now. I do not see Powell live. I think if you're talking about the Economic Club conference, we covered that in the morning. I don't think he's live right now. Yeah, he's not live right now. It was in the morning, dude. It was in the morning. And we covered. You can rewind and you can see it in the morning. But again, he didn't say anything that mattered. He literally spoke for 10 minutes and said nothing of that much relevance, at least for the markets. Okay, let's go to someone else who was on CNBC this morning. This is one of my favorite analysts from. I think she's been pretty consistent throughout the past couple of years in regards to the bond markets, the equity markets, and ultimately where she thought the S&P 500 was going, and she's been pretty accurate. And I like her eyes. So here we go. Gabriella Santos from JP Morgan. Here's what she has to say about the markets today.
booted from the Dow over this, which would be a little hasty. But what's going on under the surface? I don't mean there. I just mean with the markets more broadly.
So I think within the markets, there was a substantial lowering of the policy storm over the weekend with the agreement between the U.S. and China. We feel like we have a better understanding of what the equilibrium could be here with tariffs. We're at about 14%. We think that could be a good ballpark. It's something that's not overly disruptive, although it is, 7 times higher than it was at the start of the year. So now we're pivoting. I think the market narrative is pivoting to the next 100 days, where we're seeing elements that are more friendly to economic growth and to the equity market, including tax cuts, which is going to be the big topic going forward, as well as movements on the deregulatory front.
Let me ask you about on the tax. So this is the big kind of debate that's taking place, right? Why is the 10-year at 4.5%?
So
is it a good 4.5%? Is it a bad 4.5%? If I'm the Treasury Secretary Bessent loved when it was at 3.90.
Oh, yeah.
And he's often said his job is to be he's a bond salesman, and he's out there to sell the world on America's debt. So, we're past the sell America sort of climax, it seems. Why are yields still under pressure?
So I think it's a better environment for stocks and risk assets. I think it's going to be a more challenging environment for yields and duration, and especially the long end of the curve, which has been volatile for really the last 2.5 months. I think the initial move higher in yields was for good reason, lower recession odds, which is great, less reason for the Fed to cut rates for the right reason. From here, though, I think it's going to be all about what happens with the tax goodies included in the reconciliation bill in Congress. Because if we think about the extension of the Tax Cuts and Jobs Act, that's expected. That was baked in back in September when we saw rising odds of a Republican sweep. But the tax goodies included in the bill are between $1.5 and $2 trillion more than what was expected by the market. I think there's still some hope that maybe it gets scaled down as it goes through the remaining committees and then the Senate.
Right, but
but that's a lot that needs to be priced in.
But if it's 3.7 trillion or whatever the number is now, isn't that a little bit less in size than the bond market was fearing?
So the Committee for a Responsible Federal Budget scored it at 5.5 trillion.
Oh, did they?
So it's 3.5 trillion just to extend the Tax Cuts and Jobs Act. But that's not the only thing included. You've got an increase in the child tax credit, an increase in the deduction, no tax on tips or overtime.
Keeping a lot of the IRA breaks. Yeah,
there's a lot. And that's good in the sense that it for now is written to start this year, 2025. So help and offset to what could be some of these still tariff headwinds. However, for the bond market, that's something that we need to understand what's the right term premium for that. What's the right extra amount of yield to compensate?
And someone made a great point the other day when we were sort of going on about this. They said, well, the 10-year yield was at 5% in 2001 or whatever. We were practically running surpluses.
Yes.
So who's to say that what 4.5% represents? Now, we all know it's a challenge because the deficit's so much bigger, the debt's so much bigger, but is it at 4.5% because of those factors?
So I do think if we think about the starting point, it is substantially more challenging. We're coming into this with a 7% of GDP deficit and a debt level that's already the highest since World War II.
Which is why we need to cut rates. Like, we got a good market going on right now. We got trade deals coming up. But if we do not cut these rates, this deficit and this 10-year are just, they're going to start to creep up and rear their ugly little heads, and we're going to have broader issues right here. So I think basically what Gabriella Santos is saying right here is like, yeah, it's ugly, but hopefully rate cuts on the way can make it a little bit easier to navigate.
So you're adding 5.5 trillion to the primary deficit. Then you have to add the interest payments on top of that. So you can see how the trajectory for the deficit and the debt goes up.
Huge, yeah.
We're not here to say by any stretch that we need to see yields pop 200 basis points for that. We do think 5% was a good ceiling in October 2023 when we saw that, just that it can get a little choppy as we understand what that is. Now, this morning, there were some interesting headlines that could perhaps help offset some of this. This idea of a rethink this summer of the supplementary leverage ratio for banks, which could allow them to hold more treasuries
Right.
without being penalized
That's
and could
been
help.
hinted at by, I think, Bessent, maybe even, I think Powell has
Powell,
said
it's
he
the
would-
Fed,
yeah.
the FDIC, all the agencies behind the support because it helps with the intermediation of the treasury market.
But it's just funny because on some level, it's like, you know what? Why don't we relax the supplemental leverage ratio that came about after the financial crisis to make sure? I think that there was at least like a minimum amount of capital in banks.
Yeah.
But it's like, well, if we relax that now, they can buy more treasuries.
It can help the functioning because
And you're like, well, okay, yeah.
because it's not just the level of the 10-year, but also how crazy the movements are. And if we remember in April, at one point, the 10-year popped 35 basis points in a few days because you had an unwind of all these levered positions and you didn't have banks intermediating like they used to before the financial crisis.
That's what we talked about in the morning. The SLR ratios, if we can get those to come back down and the banks have the ability to buy up treasuries, then we're in a little bit of a better situation in regards to this 10-year. Again, rate cuts is one way to resolve it, but also allowing JP Morgan, Bank of America to just hold tons and tons and tons of billions of dollars worth of treasuries and more than what they have right now. We need that buying pressure on bond yields to bring them back down. I don't think it's something people should necessarily be worried about. Like in April when with stocks and yields, stocks were down and yields were up, but it's something you can't ignore. And I think if you're analyzing the markets every day, you have to have that 10-year in the corner of your eye just to see how the credit market is kind of interpreting Trump's ability to manage the deficit. By the way, Bessent said 2 days ago that we are going to be calling for a raise on the debt ceiling, right? And if we're calling for a raise on the debt ceiling, that just means we're going to have more money that we can borrow, and we're not going to default on our debt, which is good, but it doesn't mean we're necessarily going to reduce our deficit. So I don't think that means you get out of the markets because of that. Like I think we're always going to have a deficit, and eventually stocks will have to reason with the fact that the United States does have debt, but we are the world's reserve currency. But it can't get to the point where it just becomes absolutely insane. And the higher these yields go, the higher the interest we're paying on the debt itself, as Gabriella was saying, it starts to get a bit crazy. So I think that will be the next big challenge for Trump and Bessent to end up figuring out. Amazon right here, 204. That's down about 2.5%. Meta, 651. That's down about 1.2%. Are we getting more trade deal info on Monday? Maybe. The White House said we might be getting it on Monday when Trump comes back from the Middle East. So hopefully. But we're going to have to wait till over the weekend to see if that happens. Sane Grass, thank you for the $5 super chat. Why covered calls risking your shares instead of straight puts? I think, you can do either or. The only difference is if you buy puts on Robinhood at 55 and Robinhood doesn't meaningfully decline, your put premium goes to zero, right? And whoever sold you those puts collects the premium and you don't end up making a profit. If you sell a covered call on Robinhood at 65 and your shares, you bought them at 50 and Robinhood goes down from 63 to 58 and you get to collect all the premium on the covered call, you don't lose your shares, right? So you get to the upside of the share appreciation and you get the premium. And then if you were to lose your shares at 65, but your average is 50, you make $15 a share. Whereas with puts, you don't really have any capital appreciation. So that's why I'm more of a fan of covered calls versus buying puts. Buying puts, I'm kind of throwing money away if I'm not right on the direction of the stock. On a covered call, I could be wrong on the direction, aka the stock goes above my strike. But I could still win because if I sell for a profit, then I'm still able to make some money. So that's kind of why I'm more of a fan of covered calls. Pouncer right here, 127. Visa and MasterCard, these stocks are green on the day. Visa up 1.46% and MasterCard right here up 1%. So the payment processors getting a bit of love currently right now. Plus, you can buy back the calls at any time. Yes, exactly. So you don't have to wait for expiration. If you're up, 40, 50% in a couple days, you can buy back those calls as well. Why is Microsoft up nicely while all the other Mac 7 are down? Microsoft had the best earnings out of all the Mac 7, in my opinion, given the Azure growth they showed. I mean, Meta had a really good earnings as well, but everyone was waiting for Microsoft to really show some major AI cloud spend, and they did. So it makes sense that Microsoft is getting some love. Again, Amazon has some tariff headwinds. Apple obviously has some tariff headwinds. Tesla is, I don't think anyone can complain about Tesla, given that Tesla is green compared to where it was before earnings. But Tesla right here down about 2.7%. And then NVIDIA has a good run, or had a good run over the past couple of weeks. Google waiting for that I/O event. Meta from 480 to 650, not too bad. But Microsoft, that cloud spending definitely got the street excited. Speaking of Tesla, Jim Chanos, again, was on CNBC yesterday. Here's what he had to say about what the Tesla bulls might be underestimating about the thesis.
A company whose earnings are declining, its revenues are declining, its valuation is increasing because investors are pointing to robo-taxis, autonomous robots, and then I joked this morning, asteroid mining by robots. I mean, the stories that keep building onto this company as people put hopes and dreams on back of one company and one entrepreneur, quite frankly, are just, sort of getting excessive. And we can definitely see the profits are dropping, unit sales are dropping, margins are coming down, and yet people think that robo-taxis will be amazingly profitable and that we're all going to have a robot in our backyard doing lawn work, whatever. The reality is we might, but it might very much look like the car business itself today.
So Chanos basically saying, hey, Tesla's trading off hype. We don't know if Robotaxi or Optimus is going to be successful. And that's why he's not excited about the name. Now, again, Chanos shorted Tesla in 2016. He had $8 billion under management in his fund. He now has $200 million under management because Tesla stock went up 2,200% during the course of his short, which, if you know what it means to short, it's not easy to borrow shares that you don't own and then have to pay for them at a much higher rate. So that ended up kind of not being the best thing for Chanos. I don't know if that's going to continue to play out the way it's played out over time because, he's not shorting Tesla anymore, but it's obviously one of those things where the short sellers just haven't been able to benefit much from being against this name. We got Jamie Dimon, who did an interview this morning. Let's see what he has to say about recession, volatility, tariffs, and potential trade risks that we have in the States.
Inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
If you look at, the trade war and then the somewhat reconciliation between the U.S. and China, does it hold?
I think it's the right thing to do is to back off of some of that stuff, to have an engaging conversation. I'm grateful they did the U.S.-UK deal. It's an agreement in principle, so, there's a lot of uncertainty still, and there's a lot of uncertainty still in the China thing, but at least we started. It obviously calms down the markets. That's not the reason to do it, but the markets, do vote or something like that, and so you'll still have uncertainty to resolve. There's 90-day triggers in a lot of these things, and hopefully they will be resolved. But they're complex. I don't expect.
HIMS is down 10%, folks. HIMS is down 10%. I asked if you're buying the UNH dip in the chat, but I guess the better question is, are you buying the HIMS dip right here in the chat?
Expect immediate resolution, to the satisfaction of everybody in 90 days.
But do you expect markets to settle from here because we have a little bit more of a blueprint, or could volatility pick back up at any second?
Markets are quite unpredictable. I think there's a lot of uncertainty out there that you can't discount. War in Ukraine, terrorism in the Middle East, Iran, huge deficits, our tax bill, which I would like to see a good tax bill pass. The tariffs, the reaction of countries to tariffs. The EU and the UK are about to negotiate. I think they have a chance to actually develop a great relationship, partially making up for, the disaster that Brexit became. And so, yeah, those are uncertainties. You can't eliminate them because you want to.
But what are your biggest clients saying about this market volatility? Have they made money on the back of it?
Yeah, some do and some don't, and volatility could be good or bad depending on who's facing it. So, but I would expect continued volatility. I think it's a mistake to think we can go through all the things we're going through and the volatility itself will calm down.
Has it been good for JP Morgan? What's your trading revenue looking like?
Yes, because when there's volatility, is a very simplistic way to look at it. Spreads gap out and traders make more money if there's more volume. So we had both this time, more volatility, more volume. But very often when you have a lot of volatility and spreads gap out, there's much less volume. So you've seen examples where there's good volatility and there's bad volatility. This one happened to be good. The next go around may not be so good.
Jamie, when it comes to financials, I mean, a lot of, I guess, non-bank entrants are making quite a lot of way. Citadel, Jane Street. Is that a concern for the banks? Should it be a problem for the banks?
I wouldn't call it a problem. They're both clients and very capable. but I've always had the view there are a lot of competitors out there, and all the major banks are back. I think that's a good thing for the world. Maybe not so much for JP Morgan. You mentioned those two. There's Apollo. There's a lot of fintechs, some very good ones. There's Stripe. There's PayPal. Yeah, my view has always been the same. I tell the management, assume competition. Assume they're coming at you in every angle. Assume they often have their own strengths, sometimes their own weaknesses. They won't all do great, but yeah, I think they're, some of these people gaining quite a bit of share in parts of their business. We still are too, by the way. So, we're in the fight. We're not losing out very much, but that doesn't mean you won't lose out tomorrow because you're winning today.
So what do you have to do today? How do you see the people that are doing, well today, doing even better tomorrow?
About us or other people?
Both.
It's quality people. You interviewed Pranav. I mean, we have exceptional people.
All right. So basically, Dimon saying, hey, we got to lower the tariff volatility, but the overall economy he thinks is going to be okay. We do have some new Trump updates right here. So a couple things. Number one, Trump's rush for AI deals in Gulf opens rift with China hawks in Congress. Some Trump officials want to slow down NVIDIA and AMD sales to the Middle East. Where is NVIDIA right here? That could be affecting the semis currently right now. NVIDIA 133. Some Trump officials want to slow NVIDIA AMD sales to the Middle East. All right, so that's one headline. Number two, Mexico president calls U.S. Republicans' proposal to tax remittances unacceptable. So you got the Mexico president that's not really happy with this tax bill or this proposed tax bill. And then you have another headline right here. Trump is targeting billions in energy grants for a new round of audits. To cut, I imagine. He's trying to cut billions in energy grants for a new round of audits for the oil and gas companies. Okay, so lots of different headlines coming right there, probably creating some more volatility. Where's the S&P? We are... again, really not moving. I mean, it's down 0.35%. There's individual names like a Hood that's down 6% right here after being up a lot this week. Another individual name like Hims that's down almost 11% after being up like 70% last week. But the broader market, not really showing that type of weakness. Palantir 126, Palantir 3% down from 135 yesterday or 133 yesterday. Amazon 204, that's down. You are definitely getting red candles across the board. Broader S&P is flat grab, not going to be able to survive if the market's down 508 from 525 yesterday. And then AMD 114 after 122 yesterday as well. So if the stock in your portfolio made a nice run this week, you're giving back some of the gains. If the stock in your portfolio didn't really make a run, you're just continuing to go lower. And so it's kind of why it's a stock picker's market still. It's like, what stocks were you heavily allocated in? And how much of the gain are you giving back? Like, for example, if you're heavy in NVIDIA, all right, you're not at 136, but you're at 132. On Monday, it was at 115. Not the worst thing in the world. But then other names, that didn't really move this week, they're just continuing to get hit. Pinterest right here, 32.24. By the way, Google's working on a Pinterest-like feature. Google has been in talks to buy Pinterest for 5 years. They never ended up doing it. Yesterday, it was announced that they are working on a image search type of functionality like Pinterest. I don't know if that's really going to move the stock too much, but that is something they are working on. Pinterest right here, down 2%. Google as well, down about 0.75. SoFi, 13.36. SoFi is down 4.8%. That one getting hit. And then UNH continuing to see a bloodbath, 254. That is the low of the day on UNH. 251 was the low of the day, but still down 17.5%. What did you guys say in the chat? 79% of you said no, you're not buying UNH. 79%. All right. Well, I mean, either it's going to be a great dip buy or it's going to be one of those things where avoiding is not the worst thing in the world. Look at the heat map. Yeah, let's pull up the heat map. Let's look at the heat map for these stocks. And again, UNH is down primarily based on a Wall Street Journal article that even though it wasn't substantiated, it claims that they're going to be investigated by the DOJ for Medicare fraud. So that's kind of the major reason why we're getting hit on UNH. All right, here is the heat map for the day. Obviously, tech is red. Financials are flattish to red. Bank of America, Wells Fargo, all down. MasterCard and Visa up a little bit. JP Morgan's flat. Retail's down. Walmart earnings were good, not great. That's down 3%. Home Depot's up a little bit. Costco's up a little bit. Consumer services are down, like Disney and bookings. McDonald's up a little bit. And then the thing that's winning today are non-durables. Your Procter & Gamble, your Coca-Cola, your Nike, your Monster, etc. Energy is also down. Where are oil prices? Oil prices are 61.27. There you go. Down 3. Wow, down 3%. So energy also getting hit on the day. The market giveth and the market taketh away. This is the nature of being an investor. It's like 2 days of pure euphoria. Everything's amazing. It's fun. And then, you realize there are people that sell. And that means if you hold, those prices come down. So it is what it is. That's kind of how it plays out. I am down $31,849 today, currently right now. So yeah, you get some big 6-figure days. You'll get some low 5-figure days as well. And it happens. Is Kris in the chat? Kris is in the chat. Kris says on the ground reporting. All right, let me call Kris. Let's see what Christopher Patel has to say. Let's give him a call. United Health right here, 251, down 18% currently right now.
What's going on, brother?
Kris, good morning. How are you?
Good. I am in Savannah, Georgia, driving on, I'm about to get on I-16. I was just talking to my brother who owns a gas station around here. So he was telling me that the consumer is definitely starting to slow down a little bit. Like he's seen it himself on the ground. And the thing is, Savannah, Georgia is a very big port city on the East Coast. So if you've ever been to Savannah, like you go to the side, it's got a giant port here. And yeah, it's just container traffic because of the tariffs and stuff has kind of slowed down a little bit. But I am seeing a lot of trucks around me right now. So I think things are getting back to somewhat normal. But yeah, just overall the consumer health is not as good as it was before. Mortgage rates are definitely hitting a lot of people trying to buy houses. They're close to 7% now plus. So I think the Fed's goal of getting inflation down, it is working. Okay, I think it's working a little too well. So I would say, Powell, come on, brother, you need to start working on these cuts, my friend.
Okay, what did you think of this PPI data today? I mean, is that just more evidence that it's time to cut?
I mean, it's the start of a lot of good news for the markets in terms of rate cut expectations, but I think there's going to be a little bit more data that's going to be necessary for the Powell to really move. I feel like some of the stuff that he's been saying has been directly to kind of challenge Trump. I don't know. Do you get that feeling?
Oh, 100%. I get that feeling. 100%.
Yeah, it feels like he sees the writing on the wall. The consumers are feeling it. But Powell's like, I need to show that I'm independent from Trump. And because Trump said a few things, I think Powell's like, I'm going to give you the pain, and remind everyone that the Fed is independent, And so I think right now, I mean, all the numbers are better than where they were in September in terms of lowering inflation. Yet Powell is a little bit, I don't know, slow on the take. So my guess is either he really just wants to give Trump a kick in the nuts, or he legitimately is scared that tariffs are going to impact consumer prices, and that's the reason why they don't want to raise. But the thing is, I was talking to another friend of mine, and he was telling me, if you think about the U.S., we're 80% services?
Yeah.
Right?
Yeah.
And exports total what? 4 trillion imports? So it comes down to 4 trillion in imports. The total cost of everything, if you think about it, it's 16 billion a month. In the grand scheme of things, in a $30 trillion economy, is that really going to impact a 16 billion a month? Is that really going to impact us?
No, I mean, definitely not in a substantial way, like for a country like China. Even Walmart, they said today, dude, these tariffs are they're going to increase prices pretty soon, going to your point that the consumer is probably going to get a bit more weaker when those prices go up.
Yeah, I mean, employment, I can tell you that it's starting to like wane a little bit. Like I said, I was just talking to my brother and said, look, the jobs around here are still pretty good. There's still a lot of construction happening, but at the same time, the number of homes going up is starting to slowly come down significantly. Where there was literally for the last 3 years, there was a giant building boom where people were just building homes right and left because there was just such a big demand. And now there's a lot of places that are kind of sitting empty, and I am seeing a lot of trucks around there. So yeah.
Hey, Kris, real quick, are you speaking from your phone or is it a headset? Because it's a little.
Oh, no, hold on. It's my car's Bluetooth.
Oh yeah, definitely. I should have asked you that in the beginning.
How's that? Is that better now?
Say something.
Is it better now?
Oh, that's so much better. Yeah.
Okay, there you go.
Yeah, that's perfect. Okay, now we can really hear you. There you go.
Yeah. So no, the general consumers, I think, like especially at the bottom tier of the market, they are feeling the pinch a lot more than the top is. Okay, the top is sitting on 3% mortgages. The bottom, which are literally mostly renters, they're getting pinched, and they're getting pinched hard. So I don't know.
So you said you talked to your brother who owns the gas station, right?
Yeah.
Okay, so that is a direct gauge on people coming in and buying products. When he said the consumer is weakening, is he saying people are coming in and they're just not buying the same amount they used to buy, or he's seeing actual less traffic into the store?
So there are certain items that typically when people are flush with cash, they tend to buy a lot more of. And the gas station, you think about like a gas station and how that operates. Most of the people that are going to go there for like general stuff, they're just doing thrift stuff. Not thrift, like, how do I say, like, they're driving from A to Z and they just grab something quick, right? But the thing is, when you think about the consumer and they're like looking out for how much money they're spending, they're just like, oh, you know what? I'm going to get gas, but I'm not going to go inside as much. I'm not going to get, like a bag of chips, or I'm not going to do this extra thing. I'll just, like pack my own lunch. When you have a consumer who's really healthy, they're a lot more lax with how they spend their money. But when things are tight, they also tighten up on certain little things, So right. On the ground, that's what I'm seeing. I asked around to like other people like who own businesses and stuff down here. And, like even travel, there was a huge boom in travel like over a couple of years ago. And that's starting to slow down as well because like I have a bunch of cousins who own hotels as well, So it's like, occupancy, like now is the time where you would typically see like as kids are getting out of school, occupancy starts to go up significantly as people go to Disneyland and everyone goes through I-95, which is where most of my, like family-owned businesses are that own motels. And they're like, it's not as busy as it was in the past. Some of it, honestly, is because Disney has become so fucking I'm sorry, I'm cursing.
That's okay. That's all right. You're good.
So expensive. Like, if you look at the ticket prices, dude, it's insane how much they charge. So I think a lot of people are just kind of avoiding it. And they're just, they're a lot more likely to stay at home and spend money, more local than trying to do other things.
Okay, let me ask you about UNH 250 down 18%. Would you buy this dip?
No, definitely not.
Why?
Regulatory changes might be coming on the Trump administration side that may rework the entire ecosystem when it comes to how things are built. And then on top of it, with this probe that's happening with the Department of Justice, you don't know how much the payback is going to be for them. And the thing is, UNH runs a very tight margin profile. So if there's even a slight impact to how things are done, that might end up causing some problem. I mean, eventually it'll get so far down that it becomes a value play, right? But I don't think that the sentiment is decent enough to be in it right now. So I would say let things bottom. Just let things play out the way that they're supposed to play out, and then eventually you'll be able to get in. And I don't think we're going to see like a crazy V-shaped recovery that you typically see in tech, where you can just lay people off and boom, now all of a sudden your profitability is back to normal again and you're making money.
Right.
So I think it's going to be a little bit more of transforming how healthcare billing might be done, how much actual profitability that you can extract out of patients. I think if that changes a little bit, then something, there's something there. United Health has a lot of different divisions in it that could be very profitable. I have to really do a lot more research into how they've done, because I think they've bought a bunch of companies in the last few years that provide like support and technology to hospitals, and so they're actually getting money from their technology groups as well. So, like I said, there's definitely some work that I have to do in terms of research. But as of right now, I wouldn't touch United Health.
It is kind of incredible, right, to see a $500 billion company turn into a $250 billion company in the span of 2 months.
Yeah. I mean, I'll give you a good example of something that I've seen, like vertical integration is a big thing in healthcare. So I used to have a software program called McKesson Radiology Packs, right? That got bought by, or at least they kicked it out of McKesson Group, and they turned it into something called Change Healthcare. And then Change Healthcare was bought by another company called Optum. And Optum is like a PBM, right? So they do billing and they have like this technology portion. And so they have like multiple ways that they make money. And what's great is that these guys have like really strong, durable moats in their businesses. But once again, it's something that you really have to dig into to figure out how much value there really is, Right. But healthcare spending is never going to stop. Okay, it slows down, but it never stops. So I think eventually, if United Health can figure things out, smooth things over with the Trump administration, work things out with the DOJ where they just have to pay a fine or two, they could theoretically get back to where they were. But it's gonna be some time before they get there. Like I said, it's not gonna be as simple as like a technology company where they're just gonna lay a few hundred people off, improve margins, and boom, the stock goes back to all-time highs again.
In general, Kris, do you think de-risking right now makes sense, or how are you kind of positioning yourself?
I mean, you know me, I've been TLT, baby. That's my hedge right now. I've just been going long on TLT. I think that the Powell pivot is eventually going to come. And I think once the numbers actually start to reflect that slowdown, people are going to get into the long bond again. And, it's just, the thing is, you're going to have to be patient. The administration cannot afford the current rate of interest without really deepening their deficit problem. So if their goal ultimately is to get the deficit down, which has been stated multiple times, they're going to have to get that treasury yield to come down. Otherwise, the cost of their debt on the balance, like the U.S. debt, is going to eat away at any Doge savings, any savings on cuts, even growth is going to be sapped, right? Because if the businesses have to borrow at high rates, that means that now they're not going to be able to spend excess amount of money on things. So if the Trump agenda is to grow really fast and grow hard, they're going to have to figure out how to get rates lower. There's already talk of how they're going to do it in the background with the Treasury, but it's a work in progress. Now, one of the things that I thought today in one of the press conferences from Qatar that I think you have it. You might have it.
Yeah, the one about the sovereign wealth fund. Yeah.
Right. So someone asked about the sovereign wealth fund, and he said, "Look, the reason why these guys have a sovereign wealth fund is because they don't have any debt. We have a tremendous amount of debt, so there's no point of creating a sovereign wealth fund unless we actually get our debt in order. So if we're paying 1.5 trillion and we're saving, we're putting we have a sovereign wealth fund that's has 50 billion in it. It's no, it's probably better off just to pay down as much of your debts as possible." But I think even more than that, that was Trump's way of signaling that we're paying attention to the bond market. We are going to make sure that we're strong creditors, and that we will work on getting that part solved. And I think with Besson being in his role, being a markets guy, I think there's definitely ways that you can do it. One of them, of course, is to get the Federal Reserve to sell off its mortgage-backed securities and instead buy long-term treasuries. That should pull yields down. There's SLR changes that are coming. So I think there are a bunch of methods that the Federal Reserve and the Treasury can work together to kind of address to get the long end of the curve lower.
Right.
And eventually, if inflation comes down, and like I said, the amount of liquidity drawdown that's happening from the general consumer, it's starting to impact people. Like, imagine all these people that are paying student loans now that weren't paying them for the last 4 years. I mean, that's a big draw from disposable income, you know, where people could have gone and spent excess capital on vacations, on goods and services. They're going to say, no, I can't do that. I have student loans to pay, you know. Same thing with like insurance right now. Insurance is absolutely crazy. And one of the sad things, I don't know why insurance keeps going up so much for everything, home, auto, like.
Isn't it due to higher bond yields?
I don't think so. I don't think that's it. I think the cost of just insuring things might be getting higher. And I feel like maybe to some degree, because this is what I've seen in the background, like a lot of PE firms have been taking interest in insurance companies. And so some of the people, you know, you're required to have insurance to do X, Y, and Z.
Right.
So the thing is, if it's a coordinated effort to kind of raise insurance rates, now, you know, the consumer has to pay. Like right now, I'm driving in a car. I can't not have insurance on a car. If you buy a home and it has a mortgage, you need to have insurance on that home, you know? So I think what it is just the insurance companies, they realize they have a captive market. They know that people are, you know, the cost of replacing something is like excessive compared to what it was 5 years ago or 6 years ago. And so they understand that portion. And so they've raised rates in a way to basically compensate for that. So imagine a car, you could get a decent car for 25, 30,000, you know, 4 years ago before COVID. Now most cars are going to be closer to 35, 50. So when it comes down to it, insuring that car is going to cost way more. So the insurance rates have spiked, right? And then homes, it's the same thing. Whereas a home you could have bought for $400,000 5 years ago, right now that same home is probably going to run you $700,000. So if it runs you $700,000, that's the higher amount of asset. So the cost of insuring is going to be higher as well. You know, but incomes haven't gone up nearly as much. So yes, asset inflation has happened, but income inflation hasn't happened as dramatically as that. So it's one of those things where the consumer is definitely getting squeezed hard, and yeah, just we need a little bit of relief, pal. Cut some goddamn rates, motherfucker. I'm trying to buy a house. I'm trying to buy a house right now, bro. I ain't trying to pay no fucking arm and a leg and interest charges. Come on, pal.
Oh my God. Well, I think that's the best way to end it. He needs to cut these damn rates. He needs to
give me
cut
some
these
stimulus. I need some stimulus, bro. You know, did you ever see the Robin Williams like special where he talks about the Fed and like, yeah, baby, just give me some stimulus. Come on, man. I'll suck your dick, man. I got these cheeseburgers.
Well, when he talked today in the morning for 10 minutes, he didn't say anything too, which was, you know, I don't know if we're going to get any stimulus soon, but we desperately need it at this point.
Yo, Besson would suck his dick, bro, to get some fucking interest rates. It's like, you know they have breakfast every week, like the Treasury Secretary and the Federal Chair. Right? I'm sure that like Besson's like sitting on the other side, like, bro, what do you want? I mean, suck your dick. Suck your dick. I get goddamn rates already.
Oh my God. Sorry to the kids watching, dude, but that was funny. I'm sorry. I can't even complain. That one was funny. All right, Kris.
I apologize to anyone and any children listening, okay?
By the way, Kris, congrats on 25,000 on X. You guys can follow him right there. And thank you for being on the show every day.
Yeah, thank you guys. I appreciate everyone who's on there and tolerates my charts and like squiggly lines all over the place. You know, hopefully people are getting some value from the things I post on there.
All right, Kris. Talk to you later.
All right, take care, brother. Have a good
Later.
one.
Bro, that was funny. I'm not gonna. That one was funny. That was like, because it's funny because it goes to the point of just like Besant's willing to do anything at this point, right? Like you could just tell. Even Trump is getting to the point where the fact that Trump said, "I don't care about the sovereign wealth fund anymore because we got all this debt." He's looking at these bond yields and he's also like, "Dude, we can't freaking afford to invest in anything. We just got to pay off this debt now." So. Jokes are usually funny when there's truth to it. And the truth to this joke is that we need rates to come down. We need these cuts. And the problem is the Fed is not willing to give it, but eventually it's going to have to play out. And if it doesn't, we're going to have some issues. We are going to have some issues. I mean, we're already having some issues. It's just not affecting the stock market yet, but I don't know if rates can stay elevated at this 4.55% range for the coming months. And we don't see any issues in the broader equity markets. John Reyes, thank you for the $5 super chat. My wife and I from NYC, now living in North Carolina for a bit, have been watching your stuff for a minute. Love the energy. What's your thoughts on Symbiotic? My price is $28.16. John, thank you for being here. Thank you for watching with the wife as well. Symbiotic is an interesting one. I did some research on these guys a long time ago. They're down 6% right here. I don't really have a core thesis on this name. I can look into it a little bit more, but when it comes to robotics, warehouse, and automation efficiencies, they seem to be like at least one of the top 5 players that's there, especially based on the deal they got from Walmart and basically swallowing up Walmart's robotic division. Again, I just haven't really looked at the stock that in depth or paid attention to their headlines, but if you're betting on robotics, I think this is one of the top 5 holdings in the robot ETF. I'm forgetting the name of the ETF, but they have like NVIDIA there, Amazon, Tesla, and then they have Symbiotic. So I'll take a look at this one. I think obviously if you're betting on a robotic future, then this is not a horrible one to bet on. I really don't know enough about the company. But Walmart surrendering their business to them, to me, was pretty bullish because Walmart's basically saying, hey, instead of us doing it, why don't you guys just take control of it, since you guys are a lot more optimized for that right now. But I do think a robot future is coming. Nubank. Okay, so Nubank, again, great earnings. They had a great pump, but they couldn't really maintain it. So it went from 1280 to like 14 or 1390, very close to that. Now back to 1320. Again, it's just one of those days where every pump that we saw over the past couple of days, if your stock pumped heavy, it's giving back some of those gains, but you're still up a lot, like in NVIDIA. If your stock pumped a little bit, like a Nubank, and it's giving up a lot, then it's up very little or even red compared to where it was on Monday. So it really just depends on how some of these stocks were on Monday. Like Robinhood was 54 on Monday, got to 63, now it's at 58. I'm okay if we end the week at 58. We're up from 54. That, I'm happy. But at least we're not back down to the 50s, which maybe we could get there. But some of these names holding on to their strength, other ones just giving up some of the weakness. I mean, Tesla right here got to 350 yesterday. Now it's back at 337, but it's up from 275 on Friday. So you just can't be that upset given Tesla's price action right here. Yeah, hopefully we have that Hood $50 support for 2025. By the way, speaking of Hood, Granny Shots, Tom Lee has officially added Robinhood to his ETF. So yesterday they took out a couple names and they added Robinhood. This is an active ETF, so they could remove Robinhood, but I think they could put it out an update every single week. And hopefully this ends up being one of those names that stays in the portfolio for a long time. Palantir is also in this portfolio. They have MicroStrategy. They have a lot of these high beta names, but it's also balanced with things like Progressive Insurance. So it's not just full on risk on. But yeah, they're taking a granny shot now on Robinhood. So there we go. All right, guys, I think that is it for me today. We'll be back on the market close. In terms of earnings today, I don't think there's anything too crazy. We are here on Thursday. We have Qubit quantum name, Kava, which is a restaurant I still haven't ever ate at, which one day I have to do. Take-Two, and then Applied Materials in the semiconductor space. And then you have Kohler, which is battery technology with some Bitcoin treasury stuff. So nothing too crazy after the bell in terms of earnings. I will see if we can get Steve on today. If not, he'll definitely be on tomorrow. He's been in meetings all day, so was not able to join the open, but we'll try to get him on and get some of his thoughts as well going into the market close. We did have John Deere. I showed some of those results when Kris was on the phone. John Deere had a double beat. Their stock is up 5%, 18% beat on the top line for EPS, and then revenue they also beat by how much? By 4%. So not bad for John Deere. Someone's asking why CoreWeave recovered. Remember, CoreWeave was up big yesterday on the initial results. They went down during the call when they talked about how much CapEx they're going to spend. I think they're recovering because the market doesn't care that they're spending all this CapEx because their backlog is so gigantic. CoreWeave right here up 2%, that the market's just believing that the overall GPU reselling, renting market is only growing bigger and bigger and bigger. And given that Jensen's going to be able to sell hundreds of thousands of chips to the Saudis, there's probably going to be an even larger market for CoreWeave, SMCI, etc. And so that's why I think that one recovered. SMCI, by the way, is down about 4% on the day. It was up 16% yesterday. So that's what we got on those earnings. And then the S&P 500 to end out the market open. Look at that. I mean, a little bit of a V-shape, basically flat, down 0.06%. So really isn't even something to complain about today. Some individual stocks, yeah, they're getting hit, but the broader markets are holding up, which is important. Today's Thursday or today's Wednesday? Oh, crap. Today's Thursday. Yeah, you're right. Tomorrow's Friday. It's a quick week. Quick week. The Boston meetup. We are doing it on May 24th. If you want to sign up to the link, you can sign up right here. Again, this will be probably a bit of a smaller meetup on Saturday. I would likely have details for everyone who signs up in your email. But we will be doing the 4th meetup of the year in May in Boston. And then I'm going to be in DC in June, not for a meetup, but for another event thing. So I will be going to DC. It's going to be a very quick trip. It'll be like a day and a half. And then I'm going somewhere else in June that I think will be really cool. And I'll tell you guys as we get closer to the date. But for May, we will be doing a Boston meetup. And then Netflix. Yeah, Netflix quietly hitting all-time highs. I mean, pretty incredible, dude. Look at this chart on Netflix. Just amazing. Peaked at 700 in the bubble of 2021. Went all the way down to 165. I definitely was not the most bullish on it when it got there. But the runs since then, just incredible. Just incredible. Literally around a 7x, 165 to 1100. So 1172 all-time highs right here now for Netflix. I am coming to LA. We will do Southern California. Definitely will happen in September. I can't do it in June because the event I'm going in June is just going to be a couple days. So it'll be really quick. But LA will happen in September. Vegas likely October. And then New York will be again in November. We'll do New York in November. And I think we'll do again another New York, New Jersey, because there's a lot of New York people. New York, New Jersey in December. So we'll do the East Coast to end out the year. Hopefully Miami in August, LA in September, and then in July I still have to figure out what we're gonna do. July, maybe that's when we do Texas, but Texas I just have to spend a little bit more time to plan that out. Are we going to see you in Paris, France in June? Maybe. So I don't know if I'm going to be going to that Robinhood event. They haven't really released any of the details or any of the stuff like that. So maybe France in June for Hood. Maybe not. I still got to see. And then maybe the UK in June as well. I mean, realistically, I got to just figure out if the planning of it makes sense. The thing about it, dude, is my grandparents are coming. Yeah, exactly. I was saying this as soon as you said. My grandparents are coming in May 27th, and they're staying for the next 2 months in the States. So June and July might be a little bit harder to travel. Like even that Robinhood event, I don't exactly know if I'm going to be able to pull that off, just given the timing of it. I don't know when the dates are for it, but they haven't visited the States in like 7 years. So June and July is going to be a little bit of traveling because I do have a couple of events, but those are like 1 or 2 day things. I don't know if it's going to be full on like week-long meetups. But then August, we're going to get probably back to that, and hopefully we do Miami in August. And then I'm moving out in August as well. I'm moving out in August. So that will also be a big life event we have to plan around as well. Word of the day. What do we got on word of the day? Okay, I've never heard this one before. Crabwise. Crabwise is the word of the day. What the heck is this? Crabwise.
Crabwise.
Sideways. Has anyone heard this word? In the storage unit, they moved crabwise between teetering towards a cardboard box. He scooted his chair crabwise to get a better view of the screen. I've never heard this word before. Sideways. Okay, crabwise. Dude, I might actually use this word. The S&P 500 has been going crabwise today. UNH has not been going crabwise. But like, if I said that word in a sentence, you would not think it means sideways. I don't think anyone would think that. But there you go. That's the word of the day. This is actually an easy word to use when it comes to the markets because we do have a lot of sideways vocabulary. So crab-wise on the S&P. All right, cool. There you go. That's what we got. Again, we will have more details on the meetup for May in Boston. June and July might be a little bit chilled out again because got grandparents coming over, but we will be doing a couple of different events in June and July. They might just not be full on meetups. And then August, I think we'll resume more of the meetups. I don't know if I'm going to that Robinhood event. If I am, obviously we'll definitely do a meetup in France, but I'm just not sure if I'm going to that event. So if I am, for those that are out there in France, we will be able to meet up. And then September through December, we will resume a lot of the meetups. And then August, I'm moving out. So we got to figure out the background when I move out too, dude, because I want to bring the bricks, but I also think there's some more creative things we can do in the background. So I also don't know if the stream would even look the same if we don't have the bricks in the background. So I got to test out a bunch of different sets and designs in the new place. But it seems like the bricks might have to come with us. Lugo Ranks, thank you for being here. He says, hey, Amit, I'm 16 years old and I put your stream for the last week in the background while in high school. I want to say thank you. You had an amazing trade this week. Lugo Ranks, thank you for being here. And you know, it's becoming so obvious that young kids are realizing that the markets are a path to freedom. I mean, the fact that you're 16 and you're consuming market commentary content on YouTube over any of the other stuff that's on YouTube is pretty incredible, dude. I wish at 16 I was consuming stock market content because I just wasn't. And if I was, I mean, I think I would be in an even much better situation today. I really started discovering it around 19 and then realistically around 21, 22 got deeper into it. So I think people are just starting so much earlier these days. When I have a kid, by the time they're 5 years old, they will know how to sell puts. They will know if they have at least 100 shares of something, they can make money off of it. So yeah, it's a new generation that's discovering the equity markets. Oh, and by the way, Brad Gerstner's invest $1,000 into the S&P 500 for every newborn, which would cost like $34 billion a year. But we spend a lot of money on a lot of stupid stuff. That would be something reasonably, or not 34 billion, 3.4 billion. 3.4 billion for the United States to give $1,000 to every newborn in the United States to then let that compound in the S&P 500. First of all, it helps pump the markets because you've got money coming in to the greatest companies in the world via the S&P. B, it teaches kids financial literacy at freaking birth, right? Obviously, they're not going to understand it until they grow older, but the fact that they'll have the sovereignty and autonomy of knowing they have assets that are compounding, I mean, it's like, I think it is the best idea I have ever heard of from a policy perspective. He's got a lot of bipartisan support to get it through Congress. And I think if they get it done, our kids are going to be able to have their kids have $1,000 immediately invested for them when they're born. And that just compounds due to the beauty of the equity markets by the time they're 18, 35. I mean, it's going to be way more productive than starting to invest at 25 years old or 35 years old, right? So definitely something to look forward to in terms of that policy proposal for everyone else. You were consuming something else at that age. Dude, when I was 15, when I was Lugo Ranks age on YouTube, I was watching like philosophy videos on YouTube, right? That's why, that's why, because I was in high school, I did so much philosophy and debate, so I was so into that stuff. So I literally, when I got obsessed with debate, I would watch, for those that, I mean, you guys have probably never seen this stuff, but there's like thousands of videos on YouTube of high school debate rounds. And I would literally go to sleep listening to people debate about capitalism and democracy and all this stuff. Because when you were at a very competitive level, it's kind of like basketball, right? Or sports. If you want to be a basketball player, you watch basketball, right? Because you want to learn from watching the sport, and then you go to the gym and you practice and you try to improve your own game. Same thing with debate. Same thing with chess, right? If you want to be a chess player, you watch Magnus Carlsen and all of his tips and tricks on how to get better at chess, and you consume that content. When you're into debate, you have to consume a lot of like intellectual back and forth arguments, lectures, keynotes. And that was my 4 years in high school. That's what I watched on YouTube. That's what I listened to on YouTube. And it was really helpful for shaping my worldviews, but it did absolutely nothing for me to make more money. I guess you could say it helped me get better at debate. And based on my communication skills, that kind of helped me eventually build a career to make money. But the point is, it wasn't stock market content. And if you're learning how to trade options at 16, dude, you're just going to be an animal by the time you're 25. So awesome stuff for people that are getting into that. Lincoln Douglas here. Yes, the debate I was in was called LD, Lincoln Douglas, for those that know about debate. But I did policy as well. And so I did both. I was really good at LD, but I didn't do horrible at policy either. You know, ironically, in my debate rounds, I get mad at Kris for cursing, but I cursed a lot in my debate rounds. But like, it was strategic because like when you're in the middle of a debate and you're into like a passionate speech, like sometimes dropping the F-bomb actually like hammers down the point. And, you know, some of the judges were okay with the judges. You know, they tended to be a little bit older. They didn't care that much. But if you were just like aggressive with the cursing, they would get a bit upset and they would like rank down your speaker points. But if you were making a hell of a point, you dropped an F-bomb and it like kind of solidified your point. It was really good perceptual dominance. So yeah, I actually did curse a decent amount in my debate career. My coach would be in the background just listening. He would get so mad, but then I would win the round. He was like, I hate when you curse, but like you end up winning and you get these judges to just love you for some reason. So it is what it is. That's just how it plays out. For those asking, do I have a debate video on YouTube? I do have a debate video on YouTube. Let me see if I can find it real quick. I've linked this many times for those that have seen it before. Do I have the save? Oh, I think I have it. Yep, I have it. All right, here we go. So this is a debate from when I was on Team USA. We were in the finals of the Slovenian international tournament, and we went up against Denmark. The topic was, is class more important than race? The United States was positive, affirmative. Denmark was negative. And we said, yes, class is more important than race. We said your economic mobility or your economic status matters more than the color of your skin. And I think we whooped Denmark's ass. Unfortunately, we lost on a 3-2 decision. And when you guys get to my speech, you'll see at one point I said something and the entire audience started clapping. Dude, it was a good moment. It was a good speech for me at that state of my debate career. We had like 1,000 people inside of that stadium in Slovenia that were listening to us. And we lost on a 3-2 decision. And I think for 2 reasons. Number one, Trump was gaining a lot of popularity. That was back in 2016. And a lot of America was characterized as racist, misogynistic, homophobic, etc. It's sort of the tropes they were playing at Trump. And so when we were in Europe, I think the judges definitely had a little bit of bias against us. I'm just like, you can say that's a bullshit excuse, but you could just tell, dude, like the way they looked at us, the way they talked about us, you could hear through the grapevine. Like people really did not like Trump in Europe at the time. And they associated the American debate team as the MAGA Americans. And so I think there was a little bit of bias right there. Number two is we got to finals and, you know, we were in Slovenia. The tournament before Slovenia was in Croatia, and Team USA, my team, beat Croatia in finals on a 4-3 decision in Croatia. And then on the panel of 5 judges in Slovenia judging the United States against Denmark, one of the judges was the Croatian coach. And let's just say she didn't like us because she was really upset that we beat them in Croatia. We also beat Croatia in the semifinals to get to finals to beat Denmark or to go against Denmark. And so I am just convinced this lady hated us because if you actually watch the debate, we demolished them. Like their argument was like, oh, everyone needs to feel, you know, so much pride in their heritage and their nationality and where they come from, yada, yada. And I was like, cool, that's fine. You could feel great that you're Indian or that you're Asian or that you celebrate your culture. But if you're broke, why does it matter? Like, it's not fun to be out on the street and not have any money to your name and be begging for food and be like, oh, well, I love that I'm Vietnamese. It was just, and you know, there's a counter argument to my argument. If I was on their side, I would have a retort to that argument, but they just didn't have an argument. Their argument sucked. And I think if you guys actually watch the debate, I'm curious if people watch the debate, who do you think wins? Like the amount of applause we got as Team USA, the amount of people that came up to us in the hotel after the event were like, dude, we're sorry. You guys freaking crushed them, but looks like you got screwed on the vote. It sounds like I'm whining about it, but like, honestly, we beat them. And I'm still 10 years later, still a bit upset that we did not win the Slovenian championship. And I probably will be upset by the time I'm 75 that freaking Denmark, this girl right here, bro, this girl, their final speaker, the level of attitude she gave us in that speech, I will never forget it. She knew she was losing. She knew they didn't have good arguments, but she was acting like we are the dirty racist Americans that don't care about culture. And it was just like, no, you're just like wrong. But somehow she got 3 out of the 5 judges to vote for them. So yeah, I'm a little bit butthurt. I'm still butthurt 10 years from now. I'm still butthurt You know, when it was a 4-1, it's whatever. It's a 5-0, it's whatever. All right, we got our ass kicked. If it's a 3-2, you had one judge that just goes the other way, we would have won the championship. And so that's annoying, right? That's, you know, you think back on that 10 years later. But yeah, that's the debate video. So I'm not going to play it right here, but if anyone wants to watch it, again, I'll put it in the chat. You guys can check it out. That was one of my debate videos. I have a lot more of them. Maybe I'll share them in the future, but this is the one that's public on Team USA debating Denmark. So there you go. All right, that's it for me. Thank you, everybody. We'll be back on the market close. Beepster, thank you for the £20 super chat. That speech and that loss was when AK Media was founded. That was my villain arc. Exactly. Thank you for the super chat. That was the beginning of my villain arc. That moment, I was like, you know what? It is time to take over the world, given that we lost in that decision. Dude, it was a bad loss. I think if you guys watch the debate, I'm sure some of you guys will think Denmark won, but I think the majority of you, after you watch the debate front to end, you'll be like, there's no way 3 out of 5 judges that are competent and educated actually thought that Denmark won. I just don't think a lot of people will say that. So watch the video. Let me know what you guys think. And hopefully you guys saying I won will compensate for the fact that we lost 10 years ago. All right, that's it. I'll be back on the market close. Bye, everybody. Have a good one.